that no one single metric would enable investors to pick winning stocks. His team of analysts, he once told two biographers researching a book on his methods, looked at more than 100 different yardsticks of value when his team was hunting for bargains around the world. Earnings, balance sheets, and cash flow were all among the many indicators that his analysts studied. "We think it would be a mistake to adopt any one method," he went on. "We want our analysts to adopt whatever approaches are appropriate to a particular situation. I cannot be really specific about this. Besides, any method that is particularly successful only works if we keep it to ourselves. So we wouldn't tell people about methods that worked particularly well." At the same time, he was adamant that the successful investor should not be tied to one single approach. "The key to long-term success is to keep an open mind," he told the same authors. "And by that I mean the willingness to adapt any approach, any technique suitable for the investment, and to explore any type of investment in any place in the world." This was not just a matter of words. He himself gave money from time to time to a number of professional investment managers who followed a range of quite different approaches than his own, merely to test how well they might do. To take just one example, in the 1990s he gave £10 million of his own money in 2 tranches to Jayesh Manek, an Asian pharmacist in England who had won a stock-picking competition in a national newspaper. The money enabled the latter to start a fund, which continues today. Templeton admired his enterprise and wanted to see if he did in fact have genuine stock-picking skill. His argument that the most relevant yardsticks of value would vary from one kind of stock or investment to another was one that he was diligent in enforcing on those who worked for him. Yet there was one central idea behind his concept of bargain hunting to which he continually returned, and which lies at the very heart of his investment methodology. The yardstick of value for stocks on which he placed most reliance was earnings, and critically not just a company's historic earnings, which are known, but their future earnings, which by definition are not. The critical task for any analyst setting out to pick stocks, he believed, is to attempt to forecast future earnings more than 1 year ahead, and then to determine whether stocks are cheap in reference to their intrinsic value based on those future earnings estimates. The focus on future earnings, it is worth recalling, was already a central part of the methodology that he put forward in memos to his investment advisory clients as early as the 1940s. It was the same idea that he pitched to Dr. Mark Mobius when persuading him to launch an emerging markets fund in the 1980s. Over time, he came to refine this approach more precisely to the point where, by the time one of the current authors was working directly for him in the 1990s as Director of Global Equity Research, the focus of the analytical effort had zeroed in specifically on 5-year forward earnings forecasts as being the most important input in the stock-picking process. It remains to this day the central metric around which Templeton disciples continue to craft their regular analytical work. Clearly, forecasting earnings 5 years ahead is, however, a complex and demanding task. Most broker forecasts of earnings even 1 year ahead, for example, have been shown to have significant biases. They are so prone to systematic error that they are an unreliable basis on which to make stock-picking decisions. This is one reason why, although Templeton used broker research for background information and ideas, he insisted on using his own trained in-house analysts to carry out this important and challenging research. Although it was impossible to achieve anything like 100% accuracy in forecasting earnings, they would at least be attempting to look at what he was confident was the right variable over the right time horizon. Before looking at how this can in fact be done, it is worth returning to an important fundamental question, which is, why was Templeton so sure that 5-year forward earnings forecasts should be at the heart of his stock-picking methods? Why 5 years rather than some other period? Why earnings rather than some other commonly used metric, such as cash flow or balance sheet analysis? In the next section, we attempt to address this fundamental issue, which remains largely unanswered in other books or studies of Templeton's methods. To do so, we draw on the findings of the detailed research that one of the current authors has been undertaking in even greater depth since he first worked for the Templeton organization more than 15 years ago. As Director of Global Equity Research at Templeton Investment Management in the mid-1990s, he took it upon himself to start testing empirically some of the many investment ideas and hypotheses that John Templeton had come to believe in through his own studies and experience. One of the first of these that he set out to study was the relationship between long-term earnings, share price performance, and investor returns. This produced a set of results that, though based on just a single 5-year period, so clearly and so emphatically reinforced the wisdom of John Templeton's intuition that no further analysis seemed necessary at the time. Subsequently, however, and in order to test the validity of this initial finding more thoroughly, the study has been expanded across a wide range of other markets and periods to establish exhaustive and statistically robust conclusions. Study conclusions. The findings of these exhaustive studies can be summarized as follows. The most important imperfection in the way that the stock market prices stocks is to be found in the short-term horizons of the majority of investors. There is no statistically significant relationship between one-year forward earnings and future share price performance. It follows that there should be no surprise that stockbroking analysts have such an indifferent record in forecasting share price performance over such short periods. The same is true for earnings 2 years ahead. There is no statistically reliable correlation between the earnings a company will make 2 years ahead and its share price performance. It is only when comparing 3-year forward earnings with share prices that the first signs of a significant causal relationship begins to appear. Further analysis shows that the closest and strongest correlation between current share prices and forward earnings comes over 5 years, which was precisely the time horizon on which Templeton expected his analysts to concentrate when preparing their analysis of quoted companies. This relationship appears to hold for most markets around the world and is consistent over any period that is chosen for study. Our analysis dates back to the mid-1970s, when the comprehensive data that allows such analysis first became available. It follows that investors who can forecast within reasonable margins of error the 5-year forward earnings for most of the stocks they own are likely to be rewarded with above-average performance over that time period. It is no coincidence that 5 years happen to be Templeton's own average holding period for the stocks in his portfolios, and also the period over which his funds most reliably outperformed the market. His intuition about 5 years being the critical forecasting period ultimately derived from his own experience as an investor. The study provides strong empirical evidence, therefore, not just that Templeton was right to focus on 5-year future earnings as a key variable in stock selection, but that those who can forecast them with any degree of effectiveness can expect to be handsomely rewarded by the market. When the majority of investors are asking the wrong question, anyone who can ask the right one starts out with a huge advantage. Although he continued to study alternative methods until the end of his life, it was an article of faith with John Templeton that there was no more reliable way to produce exceptional long-term results. Having said that, however, by its nature, forecasting future earnings remains a hazardous business in which certainty can never be attained. So, while the 5-year earnings forecast remains the most reliable method of obtaining above-average results, it alone does not guarantee success. It has to be implemented well. The risk of analytical error is what makes it essential, in Templeton's view, to diversify portfolios. The Canadian fund manager Peter Cundill recalled being given some sound advice after both men once lost a lot of money in the shares of cable and wireless. I talked to John Templeton about it afterwards, and he took a worse hit than us. He said, "That is why we diversify. If you are right 60% of the time and wrong 40%, you're always going to be a hero. If you are right 40% of the time and wrong 60%, you will be a bum," adding, "I think he probably put it more elegantly than that." Findings in more detail. The initial study looked at the relationship between earnings and share prices in the U.S. market between 1990 and 1995. The coverage has subsequently been expanded to incorporate 30 years of data, every year back to 1970, companies from every sector, all investable markets, both developed and emerging, and a full range of market capitalizations from large cap to small cap. As distortions caused by survivorship bias are an important risk to any study of historical relationships, significant efforts have been made to recreate the investable universe as it would have looked in the past. Today, a team of 3 at Edinburgh Partners continues the analysis using more than 40 years of data from over 25,000 companies. The methodology used is based on the assumption of perfect forecasting ability. In other words, for any given period of historical data, the earnings actually achieved by the universe of companies being studied are compared to the price at which their shares traded at specific earlier periods, 1, 2, 3, 4, and 5 years before. The implicit price-earnings ratio at the original date can then be plotted against and compared with the eventual return that was subsequently achieved. Returns are calculated in both local and common currency, U.S. dollars, and in both nominal and real, inflation-adjusted, terms. The study demonstrates conclusively that there is a clear and unambiguous relationship between 5-year forward P/E ratios and the subsequent total return to investors. This strong and positive relationship holds over different economic and stock market cycles and across all sectors and geographies. Just as clear, and equally robust in a statistical sense, is the lack of any relationship over much shorter time periods. Caution always needs to be exercised when analyzing results for a single 5-year period. The results may simply illustrate a cyclical phenomenon, reflecting the particular circumstances of that period. Hence, the study also looks at the relationship for all 5-year periods since 1970. This, we believe, is a sufficient period of time to capture examples of most economic or stock market cycles. Events that are covered in this period include the hyperinflation of the 1970s, the deflation experienced in Japan since 1990, periods of both strong growth and recession, and both bull and bear markets for stocks. When recreating history in this way, it is important to analyze the universe of stocks that would have been available to investors at the specific starting point chosen, and not just those stocks that happen to survive throughout the period being studied. The risk otherwise is that a significant survivorship bias is introduced, which can have a material impact on the returns in particular. Shorter time periods from 1 to 4 years have also been systematically examined to investigate whether the relationship between real returns and real P/E ratios holds over different investment cycles. The findings are instructive since they make clear that there is no formal or identifiable relationship between earnings multiples and returns over these shorter time periods. The results clearly illustrated the dangers of extrapolating what appeared to be a short-term relationship into a universal truth that holds in different economic and market cycles. The results of the 2-year period from 2006 to 2008, for example, would initially suggest a reasonable relationship over this time period. Comparing this to another 2-year period, such as 1985 to 1987, however, and the relationship is almost completely reversed. In this period, the highest average returns were achieved by stocks trading on 2-year forward P/E ratios above 30. This has some important implications. Over 1- and 2-year periods, the study demonstrates that there is no certain relationship between the starting P/E, even assuming perfect foresight, and the total returns subsequently achieved. Those who attempt to pick stocks solely on this kind of methodology are therefore fated to do well in some periods and badly in others. While their methods may produce good or even spectacular results from time to time, they cannot be said to be either reliable or consistently well-founded. The only systematically consistent and reliable basis for picking stocks on the basis of forward P/E ratios is if you choose a 5-year time horizon and have the discipline and expertise to apply it. This is exactly what John Templeton set out to do and exactly what he succeeded in doing. Some listeners may perhaps be wondering at this point why so much time and effort has been devoted to what might simply be described as common sense. It is surely no surprise that investors who buy the cheapest stocks, those with the lowest price-earnings ratios based on future earnings, should subsequently achieve the best results. It is a valid question, and one to which John Templeton himself gave some thought. He was always clear that his methods were in fact no more than common sense. He conceded that calculating forward earnings estimates was difficult and required exceptional amounts of hard work, but was adamant that there was no better path to investment success than following the simple admonition, buy cheap stocks. Implications for portfolio construction. The findings of the equity study have powerful implications for the creation of investment portfolios. The study shows that there is a clear relationship between long-term PEs and real total investment returns. It also demonstrates that there is no relationship over periods of less than 3 years. The closest correlation appears to be with the real after-tax profits that a company makes over a 5-year time horizon. It follows that anyone who has a better-than-random success in forecasting 5-year earnings has the capacity to produce above-average returns. If in the long run share prices are determined by profits, it follows that the central task of the investor is to seek to forecast these profits, which is far from easy. Most of the forward-looking information available to investors, including analyst earnings forecasts, typically relates to periods that are in practice much shorter than 2 years. That the task is difficult does not remove the need to attempt it. Since the market will eventually value all stocks on this basis, any investment decision is implicitly making a judgment about a stock's long-term earnings potential. The question for anyone constructing a portfolio is how to make this judgment explicit and central to the process. Of course, if anyone had 100% accuracy in forecasting, there would be no need for a portfolio at all, since perfect knowledge would remove all the risk from the process. It would suffice to pick the best single future performer. But as nobody has perfect foresight, it makes sense to measure the risk in each potential stock by, for example, estimating a range of future profit outcomes with a probability attached to each one. From this, the investor can then build a diversified portfolio that takes account of and reflects these uncertainties. The only investors who shouldn't diversify, to repeat a Templeton maxim, are those who are right 100% of the time. The distinction between investment philosophy and investment process is critical to understanding the way that John Templeton invested. His philosophy is the belief that securities are valued relative to their long-term earnings. The investment process, however, involves assembling a range of tools that help determine what these earnings are likely to be and the margin of error that surrounds those estimates. The analytical tools, the 100 yardsticks of value mentioned earlier, are used by investors of all types, but only rarely are they directed at answering the question that Templeton understood was the one that most needed answering. Books that claim to have discovered a magic formula for generating investment returns often fall foul of the important distinction between philosophy and process. All too often they are not about how to implement an investment philosophy, but about how to apply a specific investment process. Conduct this analysis or apply this technique so the message to the reader runs, and you too can outperform the market. The reality is that, in helping to predict future earnings, no one set of analytical ratios works all the time. Different approaches work at different points in time. The formulas that grab the headlines are almost invariably based on historic data that has been back-tested to show how they would have produced outstanding results over a certain period in the recent past. The implicit assumption is that what worked before will work again in the future. Yet we know that this is not the case, which is why in many cases the recipes for success cease to produce good results almost as soon as they have been publicized. A more sensible view, implicit in John Templeton's own philosophy, is that any investment process must combine a wide range of techniques and allow for the fact that the future will not invariably repeat the past. That in turn implies understanding how and why it is that human nature drives markets to extremes of under and over valuation. In his experience, it was just as important to avoid costly mistakes as it was to pick winners. Some of the smartest and best educated people in the world work in financial markets, yet the history of investment is full of manias during which even the smartest participants find themselves owning stocks whose valuations are so high that they defy rational explanation. Simple extrapolation of past experience is often to blame. One of the most costly mistakes stock pickers make, for example, is to assume that a successful company in a competitive marketplace can go on making supernormal profits for an extended period, in direct contravention of all the principles of economics. For example, a pharmaceutical company with strong profits and cash flow trading on a historic P/E of 10 times earnings, with growth for the next 5 years, superficially looks cheap. However, if it has no drugs pipeline, and all its drugs go off patent in year 5, then it may well be expensive. Equally, if an auto manufacturer has never managed to sustain an operating profit margin over 10% in the past 40 years, is it really likely that it will do so in the future in an industry that continues to be characterized by overcapacity? A robust investment process will highlight how the margins being forecast sit in the context of historic ones, leading to a debate about whether there is any justification for this having changed. The process involves a combination of rates of growth and valuation. While the study showed that companies are unlikely to produce good returns unless they are trading at less than 11 times 5-year forecast earnings, the route by which different companies might reach that endpoint can be very different. A company that is in the early stages of growth and trades on an initial P/E of 50 times next year's earnings clearly looks expensive. But if it is in fact about to experience 10 years of strong future double-digit growth, it is not impossible that it is cheap, although the assumptions behind expecting such an outcome clearly need to be rigorously tested. Similarly, a company that is trading on 6 times next year's earnings may still be expensive if its earnings are set to fall thereafter. A robust investment process should make it difficult to make stupid assumptions. Linear extrapolation is a natural way for human beings to observe the world. That's what graphs and charts do. For most of the time, linear extrapolation represents the best forecast with the lowest error. The problem arises when the cycle changes. When that happens, extrapolation is not just wrong, but very wrong. Investors who rely on it will find themselves either greatly over-optimistic or greatly pessimistic. This, as John Templeton saw, was what created opportunities and underpinned his maxim that the time to buy was during times of maximum pessimism. When from time to time economists float the idea that the business cycle has been abolished, it is also the result of linear extrapolation trumping historical experience. It is a good example of his famous phrase that, "This time it's different," are the 4 most expensive words in the investing language. Understanding how and why investors make mistakes is, therefore, an essential part of the analytical process and every bit as important as a mastery of financial ratios. John Templeton was once asked what had made the greatest difference to the quality of his investment decision-making. He replied, "Every mile I moved away from New York." As we have seen, this is borne out by the evidence. The margin by which his fund beat the market went from 0 to 6% per annum when he moved to the Bahamas and started to work on his own. Investment analysis is, or should be, a contemplative and peaceful task. It is unlikely to be successful in an environment where the telephone never stops ringing and the analyst is distracted by multiple screens of data, all changing in real time, on the desk in front of him. To beat the market, Templeton pointed out, it is necessary to do something different from the market. The ability to make independent judgments is unlikely, therefore, to be helped by looking for guidance from the opinions of other participants in the market. Yet this is how many investors in practice choose, or are required, to operate. Information overload is an operational hazard for all modern investors. Ironically, many asset management companies go out of their way to differentiate themselves by reference to the number of analysts they employ or the number of offices they have around the globe. Access to instant information, web-based systems, and technology are deployed as reasons why they have an information edge. Yet, as we have seen, initially working alone in the Bahamas, Sir John was able to produce a track record that is unlikely ever to be bettered. He had no internet and no fax machine. His information was out of date by the time it arrived. All he had was access to historic financial statements, the contacts he had built up over many years, and the scope for extensive travel. It was the depth and clarity of his thought that determined his results, not the volume of information or the speed with which it was delivered. The way in which professional investors are organized and incentivized also often creates a bias against independent thinking. Most fund managers, for example, are judged and rewarded on the basis of the returns their funds make over relatively short-term periods. If, as the study suggests, there is no discernible relationship between share prices and valuations over periods of 3 years or less, then effective analysis of results over that time horizon has little meaning. It is impossible to determine whether the results of fund managers are the results of luck or skill. Yet this does not prevent investors from moving money in large quantities away from fund managers who have performed poorly over a 2 or 3 year period and placing it with others who have better short-term results. At the same time, the primary focus in measuring fund performance remains relative rather than absolute. It is little surprise in the circumstances that few fund managers are prepared to take the risk of deviating far from their benchmarks. The important point in this context is that business risk, or fear of losing funds or clients, militates strongly against effective decision-making in the investment business. Any investor who spends much time thinking about tracking error, or the relative performance of his portfolio against a benchmark, has already moved away from the fundamental truth that is captured in John Templeton's approach. Relative performance is a useful way of measuring the outcome of an investment process, but as soon as it becomes an input in the investment process, it is doomed to be counterproductive. Ever-improving technology is one of the spurs that challenges the modern professional investor to greater levels of activity than is either necessary or desirable, and distracts attention from what is genuinely important to the main task of forecasting future earnings. Much of the information that arrives in real time on a Bloomberg or a Reuters screen is noise, irrelevant to the investment analyst's objectives. Thanks to the Internet, graphs and prices of relevant securities can be updated on a minute-by-minute basis. Brokers are another source of pressure to trade, since trading activity drives their revenues. The role of the broker is to stimulate activity. Broker revenue is paid for by clients, and if it leads to excessive turnover, can become a meaningful cost that detracts from eventual returns. Investment firms themselves create incentives that perversely detract from the atmosphere of quiet, detached contemplation that is required to implement a Templeton philosophy successfully. It is not news that the return you can expect from owning a security is determined by its future growth in earnings. That assumption features in every modern investment and accounting textbook. The key variables are the sustainable future rate of growth and the price that an investor is willing to pay for that growth. Neither on its own, in Templeton's method, says whether a stock is a bargain or not. It is the two in combination that matter. That does not, however, stop a huge amount of time and effort in the investment world being devoted to analyzing an investor's style, and in particular to seeking to classify that style as either value or growth. While value investors focus on historic measures such as price to book, price to sales, or price to earnings, growth investors concentrate instead on future profits or cash flow growth. John Templeton is often described as a value investor, but this is an oversimplification. After all, his most famous fund was called the Templeton Growth Fund. The name gives an important clue to how important future profits growth was in his approach. His genius was to combine both styles in a simple, coherent approach that determined how much he was willing to pay for future growth and yet displayed an equal willingness to step back from ownership if the price was too high. Practical conclusions. Applying Templeton principles is conceptually very simple. It is an approach that relies on a common-sense search for value. Common sense requires that the majority of time is spent analyzing companies in a rigorous and disciplined manner to try and identify their underlying intrinsic value. Once this value has been established, it is compared to the prevailing share price. If there is a sufficient discount, it qualifies as a potential investment. The empirical evidence of the earnings study confirms that if the analysis is correct, it has every chance of producing above-average returns. The discount to intrinsic value that creates a potential bargain is a product of the sentiment that prevails in the market at any particular point in time. The analysis can be applied to a wide range of different industries and stocks, and in many different investing environments. There are always shares that, for reasons of sentiment or faulty analysis, are trading above or below their long-term intrinsic value. John Templeton's greatest insight was to see that most investors are not even looking in the right place, which makes it unsurprising that, if their analysis is good enough, those who do can expect to outperform. The proper question that any student of Templeton's approach has to ask is, therefore, why do so many investors, professional and amateur alike, continue to pick stocks on metrics for which there is no discernible or reliable relationship over their chosen time horizon? The results from such an exercise, so the study implies, can never be other than random, even with perfect foresight. The answer to this conundrum is almost certainly to be found in the institutionally short-term nature of the investment business and the fundamental irrationality of much human behavior. A mystery is, however, what it remains. Examples from the 1990s. In this section, we seek to throw some further light on how the Templeton investment philosophy can be applied in practice by drawing on some real historical examples of investment decisions that were made in the 1990s. This was a period when one of the authors of this audiobook was working directly for the Franklin Templeton Group as Director of Global Equity Research, with the responsibility of applying the principles established by Sir John Templeton to the management of an institutional global equity portfolio. The purpose is to show how an understanding of the philosophy could in practice be translated into effective action. Although Templeton himself was no longer applying his personal genius to the task of managing portfolios, he continued to meet the managers of the funds bearing his name on a regular basis to offer guidance and support. The Templeton approach has important implications for how portfolios are constructed. Many professional funds are required, for example, not to hold more than certain pre-fixed proportions in different industries and countries. However, such an approach is logically incompatible with the Templeton philosophy. A portfolio constructed on Templeton lines will be shaped by where the cheapest stocks are to be found at any point in time. At a minimum, a stock needs to offer a meaningful excess return over inflation for it to be worth including in a portfolio. If there are no stocks in a particular country or sector trading below their intrinsic value, choosing to own stocks in that category merely to conform with an arbitrary rule is, he believed, logically inimical to the investor's best interests. If, for example, 40% of the cheapest securities the investor can find are in the United States, the presumption should be that the portfolio should have 40% of its holdings in U.S. securities. This, as we have seen, is how John Templeton himself managed his own mutual fund portfolios and the discipline he imposed on those who managed funds for him. In practice, this meant avoiding, wherever possible, big decisions. The art of managing a global equity fund, in his view, was based on making a large number of individual decisions and letting them shape the portfolio, rather than following any predetermined global or macro judgments. Allied to this was his belief that the worst mistakes in investment arise when investors feel constrained to own something for reasons other than fundamental value. A disciplined approach that focuses on a series of small decisions about individual companies has a number of practical advantages. It makes it easier for fund managers to act decisively. Having to obtain consensus for a major shift in asset allocation is far harder than adding a single new stock to a portfolio. By the end of the 1980s, no asset allocation or investment strategy committee operating under conventional asset allocation rules would have dared to advocate avoiding Japanese equities entirely, as Templeton did. It would have been far too high risk. Yet, by sticking to analyzing individual companies with a strict valuation discipline, this is precisely the freedom that an investor operating on Templeton principles enjoys. If, as Templeton believed, the greatest risk in investment is paying too much for what you choose to own, it follows that, provided that the analysis of individual companies is thoughtful and diligent, the risk associated with owning something different from a market capitalization-rated index is immaterial. The real risk in the Templeton approach is that the fundamental analysis used to pick individual stocks turns out to be wrong. The value of diversification comes not from owning a wide range of different types of security, but rather from the risk that the investor is wrong about the intrinsic value of what he has chosen to own. As we have seen, even such a great investor was never precisely right. The focus on individual company analysis makes the task of asset allocation much more straightforward. If a professional investor can find enough cheap stocks to buy, then, as a general rule, it is right to be as fully invested in them as general portfolio considerations allow. If, though, as does happen periodically, the investor can no longer find sufficient cheap stocks to fill a portfolio, it makes sense to reduce the weighting in equities and hold cash instead, just as Templeton himself advised his clients to do at points in the 1940s and 1950s. Example 1. The Savings and Loan Crisis. By the early 1990s, when the Japanese stock market was finally beginning a sharp descent from its earlier highs, Templeton was no longer being criticized in the financial press for having reduced the exposure of its portfolios of Japanese securities to zero. With the Japanese market now plunging, another big theme was now on everyone's lips. It was, "Why are you investing in U.S. financial stocks? Don't you know there is a savings and loan crisis?" This was a reference to the failure of many savings and loan institutions in the United States that had lent heavily and unwisely following the deregulation of interest rates under the Reagan administration, culminating in an expensive government-backed rescue. Yet the Templeton funds at the time, in typical contrarian fashion, had started to invest heavily in financial stocks, leading to a barrage of critical questions from investors and the media. Anyone pursuing the Templeton investment philosophy for a living discovers quickly how psychologically demanding it is to have to spend so much time defending buying what other investors are discarding, which by definition is where a Templeton-inspired investment philosophy leads you. Bargain hunters, in his words, have to get used to the idea of people not confirming or agreeing with their actions. In the case of the savings and loans, the background can be illustrated by some representative headlines at the time. A short summary could be, "It is a disaster. It is terrible. It is never going to recover." These are powerful words if you begin to believe them. Although the headlines were right to highlight the troubles facing the industry at the time, The challenge for investors was to examine how far the prospects facing the industry were already discounted in the share price. An example of headlines at the time, under the heading, "What the Herd Thinks," is as follows. S&L crisis makes federal government the hottest employer in real estate. Wall Street Journal, December 1989. S&L rescue hits more cost trouble. Financial Times, May 1990. Brady says cost of S&L bailout could double. Wall Street Journal, May 1990. 1 year after signing of S&L bailout bill, industry faces same problems plus new ones. Wall Street Journal, August 1990. S&L crisis. Federal bailout agency digs the hole deeper. Information Week, March 1992. Moral: buy during times of pessimism. The share prices of U.S. financial companies, as a group, had been falling for almost 3 years. It is a good example of the general rule that negative sentiment about well-publicized disasters tends to become so extreme that it results in potential problems being over-discounted. The savings and loan companies in the early 1990s were prime examples of the best time to buy, being times of maximum pessimism. The negative headlines were already more than reflected in share prices. Many stocks had halved. During times of pessimism, it is difficult to stand apart from conventional wisdom. Never follow the crowd, another of Sir John's sayings, is precisely what has to be done at such moments. How to distance oneself from the crowd? Ignoring the headlines and concentrating solely on the operating characteristics and prospects of individual companies is an essential part of the discipline required. Buy low and hunt for bargains among quality stocks may sound like nothing more than common-sense advice, but the advice would not be needed were it not so frequently ignored in real life when troubles hit. In the case of the savings and loan crisis, the decision to invest followed a detailed examination of the provisions for real estate losses, bad debts, credit and banking ratios, and so forth on a case-by-case basis. The fact that the Federal Reserve was supplying liquidity to the market and Federal Deposit Insurance Corporation was actively providing support were important background factors, as an example of how understanding the macro background can be relevant when assessing the value of a particular company or set of companies. The weak share price performance of 3 of the companies in which the Templeton Fund invested persisted for some time after the investment was made. As noted earlier, the Templeton investment approach rarely succeeds in identifying the precise moment at which the share prices of companies deemed to be cheap hit bottom. In the case of the financial stocks, the initial average loss before the shares started their recovery was in the region of 10 to 15%. The rationale for investing in the Templeton process is that over a 5-year time horizon, the share prices of undervalued companies will come to reflect the underlying intrinsic value of the company, not that they will go up immediately. It is directed at identifying intrinsic value, not when sentiment is about to turn. Patience is definitely required. The exposure of the fund to U.S. financial stocks can be compared to the performance of the financial sector relative to the MSCI World Index. The proportion of the fund invested in U.S. financials rose during the period of negative sentiment and was later reduced before the shares of these U.S. financial stocks had reached their peak. This is the other side of the coin of being unable to judge how far negative sentiment will push share prices down. No investor can ever judge for certain how far beyond intrinsic value positive sentiment will push share prices on the upside. Chasing a share higher when its intrinsic value falls below the current share price, in the Templeton way of thinking, takes the investor beyond the realms of investment, as correctly defined, and into the realm of price speculation. Example 2. Chemical stocks and the industrial cycle. The second example concerns the global chemical industry at the time of the first Gulf War in 1991. This was a period of great political uncertainty, triggered by the Iraqi invasion of Kuwait, one of the leading Arab oil-producing states, and the coincidence of a sharp and painful economic recession. Anyone reading the financial press and analyst comments at the time would have formed the impression that the chemical industry was unlikely ever to recover from its latest setbacks. As well as being heavily exposed to the ups and downs of the economic cycle, it was widely known that the chemical industry was suffering from chronic overcapacity. Most industry analysts worked on the assumption that this overcapacity was going to take 10 to 15 years to eliminate. Experience told us, however, that this scenario was far from being unusual. It has been repeated to varying degrees during every recession of the past 70 years. In reality, the chemical industry invariably recovers, and more quickly than expected. In the late 1980s, boosted by falling feedstock prices, the chemical division of Shell Royal Dutch was returning profits of $1 to $2 billion US a year, making it the group's most profitable division. That changed dramatically in the early 1990s. Shell's chemical division was to lose nearly $1 billion US during 1992 to 1993. Such a turnaround in fortunes can have a significant psychological impact on companies, investors, and the financial press, particularly when it occurs at one of the world's most highly respected companies. What the herd thinks? Chemicals. Chemical industry warned of need for restructuring. Financial Times, December 1992. Chemical industry faces overcapacity challenge. Financial Times, December 1992. EC chemical industry sees poor prospects for 1993. Reuters, December 1992. Russian chemical industry shrinks by 22% in 1992. International Petrochemical Report, December 1992. Chemical industry output to slip by $1 billion this year. The Straits Times, December 1992. Moral? Buy during times of pessimism. This feeling of despair was encapsulated in the financial headlines of the time and manifested in the share price performance of chemical companies generally. The herd was negativity personified. The share prices of chemical companies fell in a straight line for 3 years. Share prices of chemical companies were down everywhere: Germany, Holland, the United States, and the Far East. This was a global industry where the recession looked as if it might never end. For anyone working on Templeton principles, not following the crowd and buying during times of maximum pessimism, it soon became an obvious industry to spend time looking at. The fund manager spent a great deal of time going through their balance sheets and the cash flow prospects of all the individual chemical companies, since capital stability, were they able to survive at all, was one of the key issues. Detailed study of the competitive conditions in different product groups was carried out to try to discover what, if any, sustainable return on assets the companies might be able to achieve. The conclusion was that, contrary to the popular impression at the time, a substantial number of chemical companies were trading well below their intrinsic value. It had become a classic case of the market overreacting to bad news and extrapolating current weakness indefinitely into the future. Not all the investments the fund made, it is fair to say, proved to be successful. This is not an unusual outcome for an investor pursuing the Templeton philosophy. However diligently and rigorously research is conducted, not every judgment about individual securities proves to be correct. The track record of the Templeton Growth Fund, when John Templeton was running it, as has been noted, was based on a success rate of 2 out of 3 stocks working well. Other funds have been able to beat the market with a much lower success rate. The important practical lesson is that mistakes in analysis are inevitable, and that is why running diversified portfolios makes sense. As with the financial stocks, the fund once again failed to pick the absolute lows in the share prices of chemical companies as a buying point. On average, the stocks acquired fell by 20% after the fund's initial investment. The invasion of Kuwait was one external factor that skewed the timing. The important thing was that the share prices of the fund's target companies remained well below their estimated intrinsic value. In Templeton's experience, it was better to be too early in buying cheap stocks than trying to catch them after their share prices had started to rise, when the greater risk was that the opportunity would be missed entirely. In this instance as well, the share prices continued to rise for a while after the fund began to reduce its holdings. By the end of the decade, the consensus had swung right around from despair to the belief that a shortage of capacity would continue to keep profit margins high even through the next economic downturn. This felt like the inverse of maximum pessimism, excessive optimism, and proved to be equally misguided when the post-2000 recession arrived. Example 3. Metals and the commodity cycle. A third example can be seen in the behavior of the share prices of the metals industry. In the early 1980s, the prices of most metals had started to fall in both real and nominal terms. Despite sporadic rallies, an investor would have been hard pushed to avoid substantial losses from these stocks through the 1980s. By the early 1990s, the London Metals Exchange was reporting record levels of stocks and widespread dumping of product as the former Soviet Union pushed its unwanted stocks of aluminum, for example, into Europe and the United States. At a macroeconomic level, there appeared to be no prospect of prices recovering, something that was widely reflected in the press at the time and in share prices. What the herd thinks. Metals. Precious metal prices fall in volatile trading as new data shows weak inflationary pressures. Wall Street Journal, October 1993. Base metals prices are clouded by glut of overproduction in the East and West. Wall Street Journal, October 1993. Losses at Asarco after metal prices fall. Financial Times, October 1993. U.S. copper futures fall as available stocks of the metal reach a 15-year high in London. Wall Street Journal, October 1993. Base metal price decline pushes Cominco into red. Financial Times, October 1993. Moral: buy during times of pessimism. It might be thought that analyzing companies in an industry with globally priced, homogeneous products, such as metals and oil, would be particularly difficult for a bottom-up investor who primarily focuses on individual company analysis. Actually, experience suggests that this is not the case. Clearly, in industries such as these, it is necessary to form a view about the future path of product prices. Unfortunately, attempts to produce price forecasts with econometric models have proved singularly unsuccessful whenever they have been attempted. This approach has never been part of the Templeton investment method. The better, alternative approach, and the one adopted by John Templeton himself, is to aggregate a range of bottom-up information about all the companies in an industry. From that can be derived the range of price outcomes that would be necessary for the companies to make a satisfactory return on capital over a period of years. For the major metals companies of the world, it is relatively simple to calculate what return on assets is needed to ensure their long-term survival. The analytical task is then to determine the commodity price at which the industry as a whole is able to replace its assets. This is the minimum price that will allow a mining company, for example, to finance the capital expenditure required to maintain and replace its existing mines, or for an aluminum company to maintain and renew its smelters. Unless those price levels could be obtained at some point in the future, it follows that the industry would simply go into decline. The way that competitive capitalist industries work, that in turn would eventually lead to capacity shortages and a consequent revival, after a number of years, in the industry's fortunes. What became apparent in the early 1990s was that the prices prevailing in the market were well below any realistic assessment of the price that would be required to make it sensible for companies to replace their assets. If the analysis was right, it meant that at some point in the future the price of metals would simply have to rise in order to rebalance global supply and demand. The analysis could, of course, have been wrong. For example, if it underestimated the potential for technology advancement or a new source of demand. But assuming that it was correct, Applying this implied metal price as a base case to each company in the sector made it possible to move beyond valuations based on current metal prices to estimate their long-term earnings potential. This was the investment case for buying metals stocks at that point in the cycle. The performance of 3 of the stocks in which the fund invested in 1993 was mixed. In the case of the Australian company Comalco and the Swedish company Trelleborg, the share prices appreciated sharply soon after the purchases. In the case of Union Minière, the result was less successful, although the shares did eventually rise strongly 2 years later. Note that the analysis in 1993 that suggested that metals prices needed to rise did not justify investing in all the metal companies. The focus was on those companies that careful analysis showed to be particularly cheap. In the case of some companies in the sector, there were genuine concerns about their solvency. The example once again underlined the need for diversification as a risk control measure. In the space of 18 months, the exposure of the fund to metals shares rose from under 2% to 10%. In this case, unlike the financials and chemicals examples, the share prices did fall soon after the exposure was reduced. Example 4. Pharmaceuticals and Political Risk. This example from the 1990s concerns pharmaceuticals, an industry with very different characteristics than the previous ones. By the early 1990s, the pharmaceutical industry had been a favorite of investors for nearly a decade. Most pharmaceutical companies had been experiencing earnings per share, EPS, growth of 15 to 20% per annum. They typically combined high turnover growth with robust margins and very strong cash generation. They were widely seen as classic defensive stocks, impervious to recession. Although this was conventional wisdom, it was not without merit. By the early 1990s, however, the strengths of the big pharmaceutical companies were not only well understood, but fully discounted in their share prices. More importantly, the returns that the pharmaceutical companies were making were simply too high to be sustainable. Even in a business where patent protection can shield companies from competition for a number of years, the return on assets was well above what would normally be thought of as sustainable in an industry. The headlines were again supportive, but it was not long before governments, as the major purchasers of prescription drugs, began to wake up to what was happening. At a time when recession was making fiscal deficits worse, the pharmaceutical companies became an obvious target for governments looking for new sources of revenue. Pharmaceutical companies had high profit margins and an above-average return on assets. The industry was not popular with the general public. The U.S. government, announcing the so-called Clinton reforms, was the highest-profile country to threaten a raid on drug company profits. But the same phenomenon was also witnessed in Europe, Japan, and the rest of Southeast Asia. In the face of this attack, share prices reacted in the way you would expect. The wonderful security traditionally associated with pharmaceutical companies dissipated. From being universally positive, securities analysts became almost universally negative instead. For a while, the process became self-fulfilling. Each downward tick in share prices prompted more analysts to downgrade their future expectations. By the end of the process, hardly any analyst in the world was positive on any pharmaceutical stock. In each case, a neutral or negative view was justified by reference to the lack of a drug pipeline, expiring patent protection, or both. Yet while for any individual company it was possible to believe that R&D might not produce any future winners, it was implausible to believe that all pharmaceutical companies as a group would fail to do so at the same time. Much more plausible was the view that stockbroking analysts had become too pessimistic after a period of poor share price performance. What the herd thinks. Pharmaceuticals. Generic drug stocks plunge amid fears of Clinton's war on healthcare costs. Wall Street Journal, February 1993. Embattled drug industry makes offer to Clinton. Wall Street Journal, May 1993. Reforms hit European drugs industry. Financial Times, June 1993. Another job reduction set in drug industry. Wall Street Journal, October 1993. Drug industry darkens view of Clinton health plan. Wall Street Journal, October 1993. Litany of disasters for the international drugs industry. Financial Times, March 1994. Moral: buy during times of pessimism. In these circumstances, avoiding what the crowd was doing and waiting until share prices had fully reflected all the bad news again proved fruitful. The fund's analysis kept throwing up what seemed to be demonstrably undervalued securities. The managers did not know that Pharmacia, the Swedish company, was going to merge with Upjohn and Ciba-Geigy with Sandoz, nor did they predict that the Wellcome Trust was going to be taken over by Glaxo. What the analysis did show was that Wellcome, for example, had a strong balance sheet with net cash and earnings growth in excess of 8% for the foreseeable future. It had positive cash flow and a sustainable dividend in excess of 5%. Why would you not wish to invest in such a company? Only negative sentiment prevented it from happening. It was a perfect example of how the short-term focus of most investors can drive security prices well away from their justified level, which is the assumption that underpins the Templeton philosophy of investment. In practice, after the initial scare, drug company stocks rose steadily for around 5 years. The fund's exposure to drug companies rose from under 1% to 7% over 18 months, before being gradually reduced. Again, it is evident that on the basis of perfect hindsight, the fund sold down its holdings too early. The important point is that the gains that were achieved stemmed directly from the quality of the analysis that went into the initial decision to buy, and a willingness not to be swayed by the prevailing opinion of both analysts and the media. The genius of John Templeton was to see that asking the right questions and having faith in the quality of your own analysis should, in the right hands, be sufficient to produce above-average results. Chapter 6. Past, Present, and Future. One reason for including so many examples of John Templeton's letters to his clients in this audiobook is to enable listeners to hear for themselves how he thought about the business of making investment decisions. Although market conditions are very different today than they were in the 1940s and 1950s, the process of thought required to make sense of today's world is, in essence, still much the same as it was then, just as the analytical process needed to pick individual stocks successfully remains similar to that which John Templeton first put into practice 60 years ago. His success was not so much a matter of analytical technique as a function of the simplicity, power, and consistency of his investment philosophy. This can best be appreciated by immersion in his way of thinking, for which the original source material of his own writing remains the best guide. The memos reproduced in this audiobook and in its appendix lay bare both the clarity of his thinking and the essence of his investment philosophy, which, as we have seen, while it was refined in detail, changed remarkably little throughout his long career as an investment professional. In a letter to clients dated August 12, 1958, for example, he pointed out that the firm had first printed a comment about the rewards of contrarian investing in its original brochure 20 years earlier. The same thought, to buy when others are despondently selling and to sell when others are avidly buying, requires the greatest fortitude and pays the greatest ultimate rewards, was one he was still using 4 decades later. While unfailingly on the lookout for new ideas and techniques, he was nothing if not fundamentally consistent and confident in his beliefs. While listeners can make up their own minds about the continued relevance of his thoughts and insights to the world today, in this final chapter, we offer some personal conclusions about why John Templeton was as successful as he was, highlight the key lessons that we think can be drawn from his life and career, and speculate as to what, were he still alive, he might have to say about the state of the world as we enter the 100th anniversary of his birth, a year in which the world continues to confront the painful and enduring consequences of the global financial crisis of 2007 and 2008. Templeton's legacy. The evidence we present on the performance of the Templeton Growth Fund confirms that John Templeton was, by any standard, one of the most successful and influential investors of the modern era. His track record, particularly that which he put together in the 2 decades following his move to the Bahamas in the late 1960s, rightly stands comparison with that achieved by other great moneymakers such as George Soros, Warren Buffett, and Julian Robertson. Outperforming the market by 6.0% per annum during these years, and by 3.7% per annum over his full tenure as manager of the fund, remains a remarkable achievement, not least because it was achieved without the use of debt to leverage returns. For much of the period, he operated largely on his own without the benefit of specialist research support. The fact that he achieved such consistent outperformance without exposing his investors to a loss in either nominal or real terms over any continuous 5-year period during his time at the helm of Templeton Growth Fund is the mark of someone who, we assert, can be said to have found the holy grail of professional investment: above-average returns with below-average risk. The track record is one that any investor today should be thrilled to emulate. It is a fair bet that among comparable professional investors, for whom the pressures to pursue short-term performance are now so great, his performance during the Bahamas years may never be beaten. In later life, Templeton often said himself that he would find it difficult to reproduce his track record now because of the pressures fund managers face to conform to the market's expectations. Private investors, paradoxically, have a much better chance of doing so, since the necessary information sources are much more readily available than they were in the past, and they are, in theory at least, potentially immune to the conformist demands of Wall Street and the City of London. There was nothing elaborate or complicated about his investment approach. Nothing could be simpler in principle than buying cheap stocks and holding them until their intrinsic value has been appreciated by the market. The formula is as old as the business of investment itself. The skill comes not so much in absorbing the philosophy, but in having the nerve and ice-cool temperament to execute the policy successfully over a long period of time. If it were easy, many more investors would have done as well as he did. In practice, only a handful of professionals can plausibly claim to have done so with anything like the same consistency, while the majority of private investors, we know from several studies, struggle to beat the market over any but the shortest periods. Many important components contributed to Templeton's success in an endeavor where so many others have failed. One critical one was his insistence that the stock picker's task is to look forward to the future sustainable earnings potential of a company and not simply back at its historic ratios. While it is standard practice today to look at projected earnings, few investors take the analysis as far out as 5 years, which was Templeton's preferred time frame. Picking stocks that are trading on low PEs relative to their 5-year forward earnings is, as we have demonstrated in Chapter 5, a method that is destined to produce superior results if it can be implemented effectively. To get the best results reliably, to put this another way, it is imperative that the investor ask the right questions. While Templeton remained curious and open-minded to the end of his life about the merits of alternative investment approaches, he never lost his faith in what he believed were the right questions to ask. Indeed, it was his confidence that his methods were sound that enabled him to act so decisively against the prevailing opinions of the day. Many investors, in his view, are doomed to failure precisely because they are pursuing answers to the wrong questions. Relying on historic ratios, or 1-year forward price-earnings forecasts, for example, is a method that he regarded as being incapable of producing sustainably good results. Bowing to the prevailing market opinion of the day was an easier but lazy option. This can be traced back to his view that the most important imperfection in market behavior is the short-termism of most market participants. This in turn is ultimately the result of the temperamental, institutional, and emotional biases to which all human beings, whether they work alone or in organizations, are susceptible. It is naive to believe that calculating a 5-year forward P/E ratio, let alone a 10-year forward P/E ratio, which Templeton wanted for his so-called Q stocks, is an easy task. Even the best and the brightest analysts are likely to make mistakes in attempting it, since there are so many uncertainties involved. Creating a working environment that contributes to the avoidance of mistakes is therefore central to any investment firm's process. The task requires a mixture of different analytical skills, some technical and some intuitive, some bottom-up, some top-down. In Templeton's view, the analytical task is central to effective stock picking. It cannot be readily or effectively delegated. Nor, however, can it be avoided. John Templeton cannot easily or usefully be labeled as either a value or growth investor. Such labels create artificial distinctions that he regarded as largely irrelevant to success or failure as a stock picker. As a fund manager, he would happily buy both value and growth stocks. His only criterion was that a stock should be cheap at the point of purchase. In theory, cheap could be any combination of current growth and earnings multiples, provided that the multiple of 5-year forward earnings that it implies is a realistically low number. The biggest crime an investor can commit, in his view, is simply overpaying. He himself rarely used the term value investing. Indeed, his public profile was that of a growth investor, as the name of his fund suggested. In the 1950s, he was so impressed by the potential of fast-growing companies in certain sectors that he and his colleagues launched a major research project to identify the shares of the fastest-growing companies. But he was also content to buy slow-growing companies if their earnings were sustainable and the price on offer was sufficiently low to compensate. The issue with growth companies is always, 1, whether the growth can in fact be sustained into the future, and 2, whether those improved earnings have already been discounted at the time of purchase. All the evidence suggests that investors tend to overpay for growth. Our study suggests that paying more than 11 times 5-year forward earnings for any kind of stock will be an unrewarding exercise, and that to beat the market convincingly, lower ratings still are desirable. In the Templeton philosophy of investment, valuation is ultimately the constraint that limits any investor's capacity for making consistent and repeatable gains. Or, as Warren Buffett likes to say, price is what you pay, value is what you get. An equally important factor in determining the success or failure of a stock picker is whether he or she has the temperament and patience to wait for superior results to come through. By birth and upbringing, it is clear that John Templeton was blessed with a temperament in which patience, forbearance, and confidence in the face of adversity were constants. They contributed greatly to his success as a professional investor, and by the same token, the lack of these qualities is often the reason that investors fail to do as well as they should, let alone as well as they feel they are entitled to expect. It is tempting to draw a parallel with those who achieve the highest pinnacles of excellence in sport. Talent and technique can take you only so far. Experience, commitment, and emotional intelligence are also essential. Allied to Templeton's belief in the primacy of intelligent stock picking was a conviction that investors should adjust their exposure to the stock market in the light of its prevailing valuation. If there are not enough cheap stocks to buy, then the investor should simply park his or her money in cash and bonds, and wait for the next turn in the cycle to come around, when new opportunities to buy shares at attractive prices will inevitably arise. Holding cash has two distinct advantages in overvalued markets. 1, it avoids losses as and when valuations revert to their long-term average, and 2, those with cash on hand at that point alone are in a position to profit when the market finally turns. Templeton was an assiduous student of bull and bear markets, as well as of the business cycle. As we have seen, it was his willingness to steer clear of stocks at the onset of bear markets that was chiefly responsible for his long-term track record of outperforming the world market index. The discipline to sell shares when the market had become overvalued and to buy more when prices had fallen to a level where they were cheap was integral also to the way he approached his responsibilities as an investment counselor. It is notable, however, that his methodology was based on historic valuation ratios, not on the forward-looking measures he identified as being essential to success as a stock picker. This method of constructing portfolios, when allied to good stock picking, is by its nature contrarian. Investors tend to become more bullish as markets go up and more fearful when they fall. Yet the job of the investment counselor is to persuade them to behave in the opposite direction to the one toward which their instincts are pushing them. Although we do not have the detailed records to establish the point conclusively, there is some evidence that this approach generally served clients of Templeton's investment firm well. The price they had to pay was to lag behind the market during its stronger phases. Given that most investors put a higher value on avoiding losses than they do on making the gains, this is a price that most should be happy to pay. There are a number of myths and paradoxes about Templeton's experience as an investor. In his own portfolios, he did not always practice what he later preached. The years of his greatest success with the Templeton Growth Fund only came about because he was unable to sell the fund. His experience in Japanese stocks, although it served him well for a couple of years in the early 1970s, probably did more, ironically, to damage his performance figures than any other single investment decision. His decision to sell out too early was a logical consequence of his methodology, but proved to be disproportionately costly in the late 1980s. Characteristically, this lost opportunity was something that troubled him for several years afterward. His firm was to go through a similar experience in 1999 and 2000, when a 3-year period of agonizing underperformance, as the Internet bubble inflated, was only finally vindicated by the subsequent dramatic collapse in the value of those stocks in the TMT sector, telecoms, media, and technology, that had led the market up to its unsustainable highs. Although his reputation as one of the finest stock pickers of all time is well justified, it did not stop him from making mistakes in the course of his long career. In the 1980s, for example, the Templeton Growth Fund invested heavily in Polypec, a London-listed company that subsequently turned out to be worthless and to have overstated its revenues and profits, prompting its founder to flee the country. The way he commiserated with his friend and fellow investor Peter Cundill about their losses in the shares of Cable and Wireless makes it clear that there were many examples of companies that failed to perform as he expected, prompting him to observe that a 60% success rate was more than good enough to earn a fund manager the reputation of being a genius. Despite these disappointments, Templeton remained unwavering in his view that fund managers should not allow business pressures to dictate the way in which they pick their stocks. This conviction was sorely tested during the Japanese and Internet bubbles. When one of the authors asked him for advice after cutting his holdings in emerging markets to zero, a substantial bet against the world market benchmark and what competitors were doing, Templeton replied simply, "I have never thought it sensible to buy expensive stocks for my clients." That was the end of the matter as far as he was concerned. From direct experience, we can vouch for the fact that he never blamed his analysts for making errors, provided that they had made an honest analytical mistake. The biggest crime, in his view, was not to have the courage to try. While rightly proud of his reputation as a man who, to his knowledge, never made an enemy in the course of a long career, and who regarded looking after other people's money as a sacred trust, John Templeton was not one to allow the commercial value of his gifts as an investor to go to waste. As well as being personally careful with money, even excessively so in some colleagues' eyes, he showed himself on many occasions to be alive to opportunities to increase the value of his business. Witness, for example, his advice to colleagues on the need to indoctrinate clients of their investment counseling firm about the value of the service they were receiving, or his advice to Mark Holowesko on the need for a fund management firm to launch multiple funds so that at any point in time there would always be one that was showing a strong performance. His greatest failing as a businessman was his inability over many years to maximize the commercial value of his skills as a fund manager. The first 20 years of the Templeton Growth Fund's history were, in retrospect, a long catalog of missed opportunities. Its later success, once the marketing of the business was placed in the hands of John Galbraith, was equally nothing less than extraordinary. Without it, the scale of Templeton's philanthropy would never have achieved anything like the levels it did. The fact that the fund was able to persist with exceptionally high front-end charges for so many years is a tribute not just to the fund's exceptional performance, but also to the dominance that marketing continues to play in the way that fund flows are directed. John Templeton's principal innovation as a stock picker was to insist on factoring forward earnings projections into the analytical task. This was something that he himself seemed able to do intuitively, working from published data and his own experience and observations of the world. His genius was to be able to reduce complex analytical issues to a set of simple heuristics that not only worked, but could be communicated effectively to others both inside and outside his own firm. This discipline was rooted in a deep understanding of financial history and human behavior. His ability to focus unwaveringly on the right questions that investors need to address remains a powerful example to investors everywhere. Future prospects. John Templeton was an optimist by nature and retained an inveterate faith in the capacity of humankind to confront and surmount its problems. This theme runs through all his public speeches and his many books. Not for nothing was Be Positive, the final of the 16 maxims discussed in Chapter 4. In the Templeton Plan, a primer on how human beings can find happiness, published in 1987, he declared, "Everything yields to diligence," and quoted with approval a saying of the evangelist Charles Fillmore, "There is no other spot in the universe where man has mastery. The dominion that is yours by divine right is over your own thoughts." It was a philosophy of life that was to guide his actions throughout his long career in investment. People who pursue the positive, he once noted, get results, whereas those who are cursing the evil usually don't get far. There is no doubt, however, that in the last 5 years of his life he had become concerned about the consequences of the massive buildup of debt in the developed world. In an unfinished memo drafted in June 2005, entitled simply Financial Chaos, he laid out some of his worries. "Increasingly often, people ask my opinion on what is likely to happen financially," the memo begins. "I am now thinking that the dangers are more numerous and larger than ever before in my lifetime. Quite likely, in the early months of 2005, the peak of prosperity is behind us." After this bleak opening, he went on, "In the past century, protection could be obtained by keeping your net worth in cash or government bonds. Now the surplus capacities are so great that most currencies and bonds are likely to continue losing their purchasing power. Mortgages and other forms of debt are over 10-fold greater now than ever before 1970, which can cause manifold increases in bankruptcy auctions." Turning to the outlook for the corporate and personal sector, he wrote, "Surplus capacity, which leads to intense competition, has already shown devastating effects on companies who operate airlines and is now beginning to show in companies in ocean shipping and other activities. Also, the present surpluses of cash and liquid assets have pushed yields on bonds and mortgages almost to zero when adjusted for higher cost of living. Clearly, Major corrections are likely in the next few years. Further on, he adds, increasing freedom of competition is likely to cause most established institutions to disappear within the next 50 years, especially in nations where there are limits on free competition. Accelerating competition is likely to cause profit margins to continue to decrease and even become negative in various industries. Over tenfold more persons hopelessly indebted leads to multiplying bankruptcies not only for them, but for many businesses that extend credit without collateral. Voters are likely to enact rescue subsidies which transfer the debts to governments, such as Fannie Mae and Freddie Mac. He also foresaw a continuation of growing inequality. With almost 100 independent nations on Earth and rapid advancements in communication, the top 1% of people are likely to progress more rapidly than the others. Such top 1% may consist of those who are multimillionaires, and also those who are innovators, and also those with top intellectual abilities. Comparisons show that prosperity flows towards those nations having the most freedom of competition. Despite these concerns, which he was also expressing in private, the conclusion of this memo, arguably the most downbeat he had ever written, was both familiar and reassuring. Not yet, he concluded in its final paragraph, have I found any better method to prosper during the future financial chaos, which is likely to last many years, than to keep your net worth in shares of those corporations that have proven to have the widest profit margins and the most rapidly increasing profits. Earning power is likely to continue to be valuable, especially if diversified among many nations. Since his death, many of these fears have been borne out by events. Much of the private sector debt that precipitated the global financial crisis has been, in effect, transferred to or taken over by governments. Inflation has started to rise, stimulated in part by governments' efforts to stave off a more severe economic downturn through the use of unprecedented amounts of monetary stimulus. This, in turn, has led to an intensifying sovereign debt crisis in the United States and Europe, and further declines in the purchasing power of cash and government bonds, the traditional safe havens mentioned by Templeton in his memo. In many developed countries, as he correctly foresaw, real, after inflation, yields on bonds and cash had fallen so low by the summer of 2011 that they offered savers little or no protection against loss of purchasing power. The real yields on U.S. Treasuries, for all but the longest dated issues, have in fact become negative for the first time in many years. This is in stark contrast to the situation at the start of this century, when, with equities clearly overvalued, the potential for bonds to deliver superior returns was evident to the smartest investors. John Templeton made a good deal of money for his own accounts in 2000 by a twin-track strategy of shorting shares in Internet stocks and making a leveraged bet on long-dated U.S. government bonds, which he expected to rise sharply in price as interest rates continued to fall. That profitable trade is no longer available. In fact, the decline in yields on government bonds has now run so far in the United States and many other developed countries that they offer a dangerous mix of poor value and high risk. The bonds of leading emerging market countries, most of which have avoided the trap of excessive debt, continue to look like a more attractive prospect. Many countries around the world are meanwhile engaged in an intensifying currency war, aiming to devalue more quickly than their competitors. Slowing economic growth and sovereign debt worries, coupled with the continued imbalances between the developed and developing world, prompted the International Monetary Fund to warn in late 2011 that the risk of financial instability was greater than at any time since the onset of the global credit crisis, and by extension for many years before that. Inequality, the gap between the rich and the poor, has also risen significantly since the turn of the 21st century to reach levels last seen in the 1930s. In contrast, however, the corporate sector remains in aggregate in rude financial health, with profit margins and balance sheets that are very strong by historical standards. Autumn 2011 Perspective. How, then, do we think that John Templeton would present his take on events were he still alive today? What are the prospects for investors at the autumn of 2011, when this book was being completed? Is his investment philosophy still valued in these present conditions? These are the topics to which we turn in the final section of this book. The autumn of 2011 has been characterized by violent swings in stock markets. The financial press has gorged on doom-laden predictions about future growth prospects, political instability, and the risk of potential default on sovereign bonds of many European nations. The United States is still the most powerful military power in the world, but its sluggish economy, combined with political gridlock in Congress, has seen the country lose its AAA credit rating. In August 2011, the federal government suffered the embarrassment of nearly running out of money after a bipartisan stalemate delayed an extension of its borrowing capacity. The fear of a self-reinforcing cycle of financial collapse has been stalking markets and producing ever-increasing column inches on how economic Armageddon might unfold. Before rushing to the conclusion that this outcome is inevitable, it is worth examining the wider and longer context, which we believe is by no means as dark as it might at first appear. Consider first the concerns about the lack of long-term savings in the West and the inability of both corporate and state pension schemes to fund the future retirement of the working population. How did this happen? Many companies failed to top up their in-house schemes when times were good, and many governments simply ignored the problem, hoping it would somehow go away. Perhaps the single most important factor, however, has been the improvement in mortality rates. People are living much longer than before, something that in other times would have been heralded as a sign of progress. We have, bizarrely, somehow turned the fact that we all tend to live longer into a negative. Another burden that exercises many observers is the rising cost of health care. How can we afford to fund the shortfall in future expected costs? It is a valid question, but a more positive interpretation would be that we now have the good fortune to be healthier than we were only a few years ago. That is not an unreasonable ambition for the human race, and one, you might think, that might be worthy of some celebration. As well as living longer, we also enjoy much greater access than ever to the store of human knowledge. The Internet, electronic books, and mobile broadband are not just toys to be played with. They are helping to transform the productive capability of the world. The cost of accessing information has become negligible. By eliminating the costs of print and distribution, electronic books now have the potential to make the world's store of information available to hundreds of millions more people, and at negligible cost. Over time, this has to be a powerful counterforce against rising inequality. The Internet and advances in mobile telephony hold out the prospect that in the world of the future, geography and the accident of where you are born will no longer be such a constraining factor as it has been in the past. The next generation of mobile telephony will be as important a communication breakthrough for some communities as the advent of the telegraph was for those growing up in the latter years of the 19th century. In developing nations, mobile broadband technology will allow instant access to the Internet and all that brings, without the need for heavy investment in underground cables. For the first time, rural communities in developed countries will be on an equal footing with big cities in terms of communication resources. The spread of education and literacy is continuing its rapid advance in the most populous nations of the world. In the last 25 years, China has conclusively re-emerged into the family of nations. While the pace of China's development over the quarter of a century has been breathtaking, it is still in its infancy. Until now, China has prospered because of the work ethic of its people, but its recent rapid catch-up in technological expertise will, in due course, engender a new wave of innovation. Far from being a threat to the world, this can only be a bonus. And while the United States will not easily be supplanted as the center for technological development, increasing contributions from China and India can only add to global prosperity. The strategic goals of the Chinese government now include cleaner energy, reduced pollution, and better health benefits and security of employment. With such formidable political resources officially targeting these objectives, it is likely that they will produce higher living standards and, in time, a necessary shift in the structure of the Chinese economy toward a more consumer-oriented society. Improved productivity is the key to greater global prosperity, and better health and education are important components in obtaining that objective. They are one of many grounds for cautious optimism that you won't read about in the media at this time. Readers who are interested in a corrective to the diet of gloom should turn for balance to well-argued books such as Matt Ridley's The Rational Optimist, HarperCollins, 2010. Pessimists, of course, will revert back to the problems of the financial sector and a steady succession of scandals and fraud. John Templeton rightly pointed out that abusing weights and measures is a breach of trust by government, and there is no doubt that many institutions have lost the trust of their constituents. The optimist will note, though, that the market is now clearly penalizing those for whom trust has become a scarce commodity. In many countries today, we can see signs of a reaction against those, such as bankers, legislators, and bureaucrats, who have abused their position. Financial institutions that trumpeted profits that they were later forced to concede were no more than accounting sleight of hand now sit under a cloud. They will continue to do so until investors have confidence that their trust is no longer being betrayed. Governments, meanwhile, are slowly but surely losing their gold-plated credit ratings as unfunded spending commitments come home to roost. Political developments globally, it is even possible to argue, are also starting to move in a more favorable direction. Politicians are losing the ability to buy off voters with promises that their countries cannot afford. Voters in the Western democracies are discovering that the days of living on credit are over. The political classes have been slow to recognize this, but the day when they have to acknowledge this new reality cannot be delayed indefinitely. No doubt there will be continued efforts to maintain the deception that debt can be accumulated without cost. However, many of the developed nations have exhausted the store of wealth built up over many decades and can no longer, in aggregate, spend more than they earn. The focus will therefore shift away from consumption to earning and saving. As a result, the coming decades are likely to witness a renaissance in the productive and manufacturing industries of the West. John Templeton would not have succumbed to the Western-centric bias of much comment about current developments in the world. The so-called BRIC countries, Brazil, Russia, India, and China, are experiencing a mirror image of the developments in the leaders of the developed world. In these countries, a strictly mercantilist view of the world, built around export-led growth and a culture of domestic savings, will gradually give way to more balanced economies. Just as the West has exhausted its store of wealth and is only now beginning to realize that it can no longer consume more than it earns, so the East is waking up to the fact that it is richer than it realized. The capital that the BRIC countries are accumulating will have to be recycled, just as happened after the Industrial Revolution. Chinese and Indian multinationals will emerge to rival the industrial giants in the United States and Europe. The release of pent-up demand in these nations and the innovation that will accompany their emergence can only assist the growth of the productive potential of the world economy. The year 2011 was marked by political conflict in North Africa and the Middle East. If anyone 10 years ago had dared to predict the popular movements that have swept away dictators in Libya, Tunisia, and Egypt, they would have been regarded as dangerous optimists. It is characteristic of today's sober frame of mind that now that this has happened, instead of rejoicing, many people in the West are too busy worrying about the potentially negative consequences. It is evident that the way forward for these countries is uncertain. But seeing democracy advance rather than retreat was always for John Templeton a positive rather than a negative development. There are many dangers facing the world and big challenges facing policymakers and investors, but there is nothing inherently new in that. It was ever thus. The founder of the Templeton Growth Fund lived under the permanent shadow of a nuclear war for nearly 40 years. Yet this did not prevent him believing in the capacity of the human race to grow and prosper. The lesson to be drawn from his life and career is that investors should not lose sight of the resilience of the global economy and mankind's capacity for progress. Implications for investors. As is always the case in hard times, the question to be answered by investors is how much negativity is already being discounted in the price of shares, bonds, and other financial instruments. Combining a positive frame of mind with the perspective of overall valuations, we would argue that, at the time of this book's writing, there are more reasons to be optimistic than at first appear. For committed long-term investors, stock markets are no longer discounting unrealistic growth expectations. In fact, it is probable that they will be the best-performing asset class for the foreseeable future. In an environment where we can expect global growth after inflation to run at the rate of 2 to 3% per annum, it is not unreasonable to expect that 10 years from now the S&P 500 index could reach 2,200. That would represent an approximate doubling from the current level, which is 1,131 at the time of this book's writing. Yet at that level, it would still not be standing on a cyclically adjusted valuation that is high by historical standards. We have added similar target figures for 3 other markets: the United Kingdom, Germany, and Japan. Needless to say, these are intended to be the central estimate in a likely range of outcomes, not precise predictions. John Templeton was never foolish enough to say that his statements about future market levels were cast in stone, and we do not wish to make that mistake either. We do, however, think that these are landmarks that are capable of being reached in the next 10 years. How did we arrive at these figures? We did so by applying the methodology that John Templeton developed. We have combined a plausible further valuation range for the market with conservative growth and inflation estimates, and then translated them into targets that are consistent with these numbers, as well as with historical experience. One thing that leaps out in our data analysis is how exceptional a period for investors the 1990s were, when set against historical experience. That decade witnessed both the culmination of the greatest bull market in equities in recorded history and a strong performance by bonds as interest rates and inflation expectations fell around the world. The rating applied to the stock market soared in response to abundant liquidity and the reemergence of China and other emerging markets as a force in the global economy. This golden period for stocks could not be sustained indefinitely, and since the turn of the century the trend has gone into reverse. The de-rating of equities accounts for a substantial proportion of the poor returns that this asset class has witnessed in recent years. Company earnings have not fallen significantly over the past decade. It is the multiple that investors have been prepared to pay for those earnings that has come down so dramatically. Clearly, that process may not yet have run its full course. However, we are now at a point in the global cycle where the valuation of many developed markets has fallen far enough to mean it is now close to the long-term average, based on the cyclically adjusted price-to-earnings ratio. The same is true for the UK, Japanese, and German stock markets. While the data series for these countries do not cover as long a period as that for the United States, the long-term average is consistent with longer-run U.S. experience. The other markets did not reach quite such high valuations in the 1990s, but the trend since then has been broadly similar. They, too, are no longer so obviously overvalued as they once were. In fact, on some counts, they look more attractive than the U.S. market. The important implication of this is that it is likely that equity market returns will be driven as much in the future by earnings growth as by further changes in valuation. That in turn implies that while future returns from equities will not match those on offer when markets were very low by historical standards, they should offer positive returns in both real and nominal terms. There is a well-established inverse correlation between the cyclically adjusted P/E ratio and subsequent real, inflation-adjusted returns from equities. The higher the adjusted P/E ratio, the lower in general the subsequent return, and vice versa. Could they still get cheaper than they are now? Yes, certainly they can. Share prices can always fall further and faster than basic valuation measures suggest. The issue, however, as John Templeton always saw it, was how the rational investor should respond to the evidence of over- or undervaluation in the markets. His years of experience led him to argue for a simple, measured response. In his view, when shares were expensive, it was inherently dangerous to hold on to them all in the hope of finding a greater fool to buy them later on. Equally, when they did offer good value, it was foolish not to invest in companies on the grounds that they might conceivably be available to buy at lower prices at a later date. The risks of being wrong, in either case, were simply too great to justify such behavior. History, according to his research, provides no empirical support for failing to buy equities when they are cheap, however unappealing conditions at the time might appear to be. Adapting the Yale method, current valuations might suggest that it looks risky to make much beyond a normal allocation to equities. While not unreasonably valued, they are certainly far from being dirt cheap. There is another dimension to consider, though. Sir John invariably stressed the need to focus on real, not nominal returns when considering alternatives in investment. The effect of inflation on wealth is pernicious, and inflation remains a potent longer-term threat in today's global environment. In their efforts to stave off the impact of the credit crisis, governments in developed countries have slashed interest rates and resorted to wholesale printing of money and other forms of loose monetary policy. This is not only inherently inflationary, but has also helped to distort investors' perception of risk. What this means is that cash and government bonds are no longer the safe alternatives they traditionally were. Interest rates on savings accounts and money market funds have dwindled to almost nothing, offering little, if any, protection against inflation. Government bonds in countries such as the United States and the United Kingdom, in many cases, also offer negative real rates of return because their yields are below the rate of inflation in the issuing country. Each and every year, in other words, investors who buy bonds at these prices can expect the purchasing power of their investment to diminish. If you share Templeton's view of the importance of governments maintaining the integrity of a country's weights and measures, the willingness of many countries to debase their currencies and the value of their bonds is a disturbing development. Only a dramatic fall in future inflation will justify investors buying U.S. or UK government bonds at 2011 yields and hoping to make a real return over anything but the shortest of time horizons. The best indicator of future bond returns is the real after-inflation yield. This is now negative, and that historically has not been consistent with anything other than losing money over time. Although some ultra-gloomy investors appear to think that an extended period of deflation now lies ahead, historical experience provides little comfort for this view. For the best part of 40 years, between 1940 and 1980, buying U.S. government bonds was an almost surefire way for savers to lose the purchasing power of their money. It was only after inflation peaked in the late 1970s that bonds once more began to offer positive real returns. This trend was supported by tight monetary conditions, deregulation, and government policies designed to encourage enterprise and growth. These policies are the exact opposite of those now being followed by Western governments in the aftermath of the global credit crisis. In the 1980s, those policies helped to usher in a golden era for bond investors. Inflation fell from 15% to less than 5%, and the resulting fall in bond yields sent bond prices soaring. With real yields on government bonds now in negative territory, the opportunity for a repeat of this experience no longer exists. The risk is all on the other inflationary side of the equation. Let's compare and contrast. Someone who invested in equities in the late 1990s would have obtained a negative real return 10 years later. In contrast, for someone who invested in U.S. 10-year bonds, the annualized real return over the next 10 years would have been somewhere above 4% per annum. The critical point, one that John Templeton emphasized at all times, but which many investors appear to forget, is that a realistic target return from either equities or bonds is heavily dependent on their respective valuations at the point of investment. We obviously do not know what the actual realized returns from an investment made in 2011 will turn out to be, but it is long odds on, given their respective valuations, that equities will produce a higher 10-year return than U.S. government bonds. The former are relatively cheap, and the latter both relatively and absolutely expensive. The historical experience with equities is not so discouraging. Certainly there have been many periods when returns from equities were poor. The last decade has been one of them. Since 2000, investors in bonds have continued to make positive real returns, while the real returns from developed market equities have slumped. Equities in many emerging markets have delivered much higher returns, however, underlining the way that economic power has shifted from west to east, a trend that John Templeton was one of the first to identify. This experience helps to explain why investors have such a negative view on equities as an asset class. It was also what John Templeton himself anticipated with the shifts in his own portfolios at the start of the decade, buying government bonds. Equities have been poor on both an absolute basis and relative to bonds. The explanation is readily apparent from the cyclically adjusted P/E ratios. Although the returns of the 1980s were repeated in the 1990s, they were not underpinned by sustainable growth in earnings as they had been in the previous decade. Instead, market valuations simply rose to a level from which they were bound to decline, and that decline outweighed any earnings growth. Today, however, the cyclically adjusted earnings ratio no longer sits at such elevated levels and has fallen back, closer to the long-term historic average. As such, it is reasonable to expect that returns from here on will also fall within their historical ranges. So, while equities, particularly in the United States, are not obviously cheap, they do have the advantage that they can offer what the traditional safe havens no longer can, which is protection against the loss of wealth. If we assume that global growth remains relatively anemic for a few years, but that inflation averages approximately 3% per annum, which may well prove to be an underestimate, then it is reasonable to expect that the major stock market indexes will double in nominal terms over the next 10 years. Adjusted for inflation, this would equate to a real return of approximately 4% per annum. While this is lower than the long-run historic return on equities, which is around 7% per annum, it nevertheless does hold out the prospect of an above-inflation increase in wealth. On almost any scenario, barring only a rerun of the Great Depression, The 10-year return from equities is likely, therefore, to be well above the return available on U.S. government bonds. The average real loss from owning bonds over 10-year periods between 1940 and 1980 was well over 10%, and in some periods 2 or 3 times that level. Investors eventually caught on to the fact that they needed to earn a positive real interest rate as a reward for holding government securities. Those investors today who feel safe with government bonds will in due course come to realize that this feeling is misplaced. Much greater safety over the next 10 years is likely to be found in equities, given today's relative valuations. The key, as the subject of this book repeatedly pointed out, is to remember that investment in equities is an investment in the future growth of the world, and that as long as one does not pay too much for them, one can expect to be rewarded over time. We have no doubt that equities would be John Templeton's preferred asset class in today's environment, as indeed he suggested at the end of his memo on financial chaos that we quoted earlier. Progressively buying when stocks become cheap and progressively selling when they become expensive is what John Templeton did. It worked for him, and it can work for those who have outlived him. Despite the gloom that settled on investors in the course of 2011, the outlook for equity returns, while hardly the greatest bargain they have ever been, has improved. The economic Armageddon being predicted by some is not the most likely outcome. More likely is that policymakers in Europe and the United States will, to paraphrase Winston Churchill's view, arrive at the right answer, but only after exhausting all the alternatives first. The fact that investor confidence is so low at the time of this book's writing is an additional source of comfort. If he were with us today, we believe that John Templeton would point out that the gloom in financial markets now offers grounds for optimism. As he repeatedly said, the best time to invest is always at the time of maximum pessimism, and we appear to be closing in on that point in this market cycle. Appendix: John Templeton's Advice to Investors. In addition to letters to clients of his investment firm, John Templeton wrote many words of advice to investors, as well as being quoted regularly in books and newspaper articles about his views on the art of successful investment. In this section, we reproduce his best-known and most pertinent observations. Perhaps his most famous piece of advice came in the form of a series of maxims or aphorisms, which he used in a number of different places and which he added to on several occasions as his fame spread. This is the longest and most definitive list of these maxims that we have been able to find. It can be usefully compared to the shorter version, based on an article that appeared in a now-defunct publication, the Christian Science Monitor's World Monitor, which we used as the basis for our comments in Chapter 4. Number 1. For all long-term investors, there is only one objective: maximum total real return after taxes. Number 2. Achieving a good record takes much study and work, and is a lot harder than most people think. Number 3. It is impossible to produce a superior performance unless you do something different from the majority. Number 4. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Number 5. To put maxim number 4 in somewhat different terms, in the stock market the only way to get a bargain is to buy what most investors are selling. Number 6. To buy when others are despondently selling and to sell when others are greedily buying requires the greatest fortitude, even while offering the greatest reward. Number 7. Bear markets have always been temporary. Share prices turn upward from 1 to 12 months before the bottom of the business cycle. Number 8. If a particular industry or type of security becomes popular with investors, that popularity will always prove temporary and, when lost, won't return for many years. Number 9. In the long run, the stock market indexes fluctuate around the long-term upward trend of earnings per share. Number 10. In free enterprise nations, the earnings on stock market indexes fluctuate around the replacement book value of the shares of the index. Number 11. If you buy the same securities as other people, you will have the same results as other people. Number 12. The time to buy a stock is when the short-term owners have finished their selling, and the time to sell a stock is often when short-term owners have finished their buying. Number 13. Share prices fluctuate much more widely than values. Therefore, index funds will never produce the best total return performance. Number 14. Too many investors focus on outlook and trend. Therefore, more profit is made by focusing on value. Number 15. If you search worldwide, you will find more bargains and better bargains than by studying only one nation. Also, you gain the safety of diversification. Number 16. The fluctuation of share prices is roughly proportional to the square root of the price. Number 17. The time to sell an asset is when you have found a much better bargain to replace it. Number 18. When any method for selecting stocks becomes popular, then switch to unpopular methods. As has been suggested in Maxim 3, too many investors can spoil any share selection method or any market timing formula. Number 19. Never adopt permanently any type of asset or any selection method. Try to stay flexible, open-minded, and skeptical. Long-term top results are achieved only by changing from popular to unpopular the types of securities you favor and your methods of selection. Number 20. The skill factor in selection is largest for the common stock part of your investments. Number 21. The best performance is produced by a person, not a committee. Number 22. If you begin with prayer, you can think more clearly and make fewer stupid mistakes. Source: William Proctor, The Templeton Prizes, pages 118 to 120. Reproduced with permission. Templeton's letters to his clients. The archive of letters that Sir John Templeton sent to clients of his investment counsel firm Templeton, Dobro, and Vance between 1940 and 1962 provides a rich source of material for students of investment. A number of these have been reproduced in full in Chapter 2. Here we reproduce a further small sample from the archive, grouped into a number of sections. They contain some fascinating insights into how his thinking about investment developed in the aftermath of World War II. This was a period during which the American economy grew strongly against a background of continued international tension. The post-war period was punctuated by periodic crises, most notably the Berlin airlift crisis of 1948, the Korean War in 1951, Suez and the Hungarian Uprising in 1956, and the Cuban Missile Crisis of 1962. In the world of investment, two features of note that emerged toward the end of the period were, 1. The first signs of inflation as an endemic feature of economic life in developing countries, and 2. The reversal of the traditional relationship between the valuations accorded by investors to equities and bonds. Historically, equities had always yielded more than bonds, but since 1957 that relationship has reversed, creating the so-called reverse yield gap. Until the 1960s, individuals remained the most important source of investment demand in the stock market. It was not until the late 1960s that mutual funds began to grow rapidly, eventually becoming the medium of choice by which private investors participated directly in the investment markets. The 3 decades since the 1980s have also seen a dramatic increase in institutional investment, with a corresponding decline in the amount of stocks and shares held directly by investors rather than through funds. Stock markets. What follows are some examples of the letters that John Templeton sent to clients of his investment counseling firm discussing the level of the stock market and its implications for their portfolios. The message in each of them runs on broadly similar lines. This is where the market is trading. This is how that compares to the normal level, as calculated by the firm, with reference to historic earnings and replacement cost of assets, and this is what it means for the client. They invariably mention the advantage that comes from having cash in reserve to take advantage of those occasions when the market does fall below its normal level, and the benefits of reducing the equity exposure when the market has risen above that level. This contrarian approach was the essence of the Yale method. The efficacy of the method depended a good deal, of course, on the skill and accuracy with which Templeton and his colleagues were able to calculate the value of normal. February 9th, 1948. Ratio of stock yields to bond yields. In selecting a stock for purchase, the dividend rate receives more attention than any other one fact, especially among non-professional investors. The high cost of living has caused more and more people to seek stocks that pay high dividend rates. Therefore, it is interesting to know that more than 100 listed stocks are now available, paying better than 10% return. Table 1 lists 112 stocks, each of which paid dividends in 1947, as great as 10% of the January 7, 1948 market price of the shares. All of these stocks are listed on the New York Stock Exchange or the New York Curb. There are now, of course, many non-listed stocks with yields equally as high as those in this table, and also many listed stocks which would qualify for inclusion in the table if the market price declined only fractionally. Obviously, Templeton included tables in his letter to clients. The abundance of high-yielding stocks results in part from the decline in stock prices in the last 19 months, and in part from the increased dividends and extra dividends declared in the last few months. The average yield on the 65 stocks used in the Dow Jones averages is now 5.36%. By comparison, the yield on the 40 bonds used in the Dow Jones average is 3.79%. The stocks yield 41% more than the bonds. This is unusual. The past history on this subject can be studied in Table 2, which shows the ratio between stock yields and bond yields for each year from 1871 to 1946. For the years prior to 1939, the source of this data is Common Stock Indexes by Alfred Coles III and Associates. And for later years, the figures in the table are the yields at the end of the year from the Dow Jones Index of 40 bonds and the Index of 65 stocks. In only 2 of the 76 years covered by this table were stock yields so great in comparison to bond yields as they are now. To some extent, the stocks whose dividend payments are high in relation to market price are concentrated in 9 industries. 1. Amusements. 2. Automobiles, trucks, and parts. 3. Food and beverage. 4. Merchandising. 5. Mining and metals. 6. Railroad and railroad equipment. 7. Sugar. 8. Textiles and apparel. And 9. Utilities. However, the scattering is wide enough that it would be easy to make up a well-diversified portfolio consisting solely of stocks yielding over 10%. This list of stocks, yielding 10% or more, is presented as an interesting curiosity, a peculiar phenomenon of the times. It is not presented as a means for selecting stocks for purchase. Probably the long-range overall results would be better if stocks were selected at random rather than from this list. As a general rule, it can be taken for granted that a stock will net sell as low as 10 times dividends if security analysts and persons close to the company expect the dividend rate to be long maintained. The dividend rate is only one of a multitude of factors that should be studied when selecting a stock for purchase. All other factors being equal, for the investor with a low income tax bracket, it is better to buy the stock paying the higher dividend, but seldom ever can it be said that other factors are equal. Because stockholders are conscious of the dividend rate more than other facts, this element is often overemphasized. To be successful in the management of securities, it is necessary to buy the stocks that are oversold and to sell stocks that are overbought. Stocks with a high dividend rate are seldom oversold. Real bargains, from a long-term viewpoint, are found more often among stocks which have paid little or nothing in dividends for several years. September 21st, 1948. The best thing that could happen. The stock market went down yesterday. My friends in Wall Street are sad. I can understand their emotions, but it only illustrates again the fact that more and more investors should adopt and adhere to the long-range non-forecasting programs used by the clients of Templeton, Dobro, and Vance Incorporated. These programs are designed to profit from stock market cycles without the need for predicting such cycles. For an investor following a program of this nature, as we have said before, the best thing which could happen is to have the stock market go down from today's level of 177 to 128 before the next long bull market begins. An investor following an average program has 70% in common stocks today that will participate in the capital gains during the next bull market. However, if the market declines to 128 before the bull market begins, such an investor will have 100% in stocks with which to participate in future capital gains. In other words, if a bull market begins now, the investor will make a large profit. But if the market first declines to 128 before the bull market begins, he will make an extra $19,000 approximately on each $100,000 involved in the program. If the market continues to decline, the long-range programs will call for purchasing more stocks at successively low levels. Of course, if there were any way to know for sure that the stock market would decline to 128, we would wait until then to make any purchases. In fact, we would go further than that and sell out the stocks now held in order to repurchase at the bottom. But the fact is that no one can possibly know for sure what the stock market will do. It is also possible that a long bull market may start immediately. If there were any way to know this for certain, we should immediately buy common stocks on margin at once. Here again, no one can possibly be sure what the stock market will do. The prudent and conservative policy is to follow a long-range program designed to profit from stock market cycles without the need for predicting either the timing or extent of such cycles. Because the stock market declined yesterday, and is now 9% below its level 3 months ago, investors generally are unhappy. Even for those investors who have not yet adopted a long-range program, this emotion is illogical, if such investors are still in the stage of accumulating their wealth. Low market prices work to the advantage of an investor who makes it a practice to reinvest dividends, or an investor who makes annual savings from his business or salary. For more than 2 years, stock prices have been remarkably low in relation to earnings. In fact, today stock prices are lower in relation to earnings than in any peacetime year as far back as records are available. This means simply that a person with new money to invest can obtain unusual bargains. He can buy shares in some of America's largest and soundest enterprises for less than 5 times the current rate of earnings. If the current rate of earnings is maintained, the net worth of his shares, plus the dividends received, will cause the value of his investment to double in less than 5 years. Even if future earnings were only 1/2 of current earnings, his purchases would still represent attractive bargains. This memorandum is not written merely to point out the silver lining of a cloud. It is intended as a part of the long educational program to persuade more and more investors to adopt sound and long-range investment programs. August 1953. Lower prices expected. The Dow Jones average of industrial stock prices is now 271. We expect and hope that this average will decline below 190. Most of our investment counsel clients follow long-range programs of the non-forecasting type. The program of each client is designed to fit his own needs and wishes. A typical program would call for having 60% in common stocks when stock prices are normal and 100% in common stocks when stock prices are very low. The change from 60% stocks to 100% stocks is made progressively, step by step, each time the general level of prices declines another 10%. The increased proportion of common stocks purchased at these successively lower levels is then held until stock prices eventually return to normal. When that happens, the proportion of stocks is reduced back to 60%, which means automatically that profits are taken and the fund is larger at the end of the cycle than at the beginning. Our economic and financial studies now indicate that the normal level for industrial stock prices during the next 10 years may be between 289 and 303 on the Dow Jones average. When prices decline 10% below normal, which means about 260, the typical program mentioned above calls for increasing common stocks to 70%. It calls for increasing to 80% in stocks at 234, 90% at 211, and 100% at 190 on the Dow Jones Industrial Average. That is why we hope the market will decline to 190. Only in that way will this typical client have an opportunity to use all of the reserve funds he is holding for the purpose of purchasing common stocks at bargain prices. Of course, when preparing the program, it would be possible and reasonable to schedule the purchases more closely together and thereby use up the reserve fund before the market declined as low as 190. Every client has a different program, a program designed to fit his own needs and wishes. Some clients have more stocks than others. Some are never completely in stocks and never completely out of stocks. Without changing the basic method, the variations are infinite. The reason why the particular program mentioned is not designed to use all of the reserve fund until the market is below 190 is the fact that it seems reasonable to expect that prices might go that low during the next bear market. This would be only 34% below normal and only 30% below today's prices. The history of stock market cycles during the last 50 years teaches us that we ought to expect prices to decline more than 30% below normal once or twice in every decade. In the next memo, John Templeton expands on a theme that was to become a leitmotif of his approach to stock picking over the years. He notes that institutional investors are starting to buy blue-chip stocks, driving up their valuations to heady levels, with price-earnings ratios above 20 in many cases. These are price entry levels, he notes, at which investors are unlikely to be well rewarded over time. Bargain hunters will be better served looking at stocks selling for less than 10 times earnings. December 1953. Today's premium prices for those stocks favored by trustees. Some stocks are more stable in price than others. Stocks that have had a long record of stability in prices, earnings, and dividends are referred to as high-quality stocks. These are usually the shares of large and famous companies operating in industries of a non-cyclical nature. Between October 17, 1951, and December 2, 1953, there has been a remarkable divergence in the price trends of high-quality stocks compared with the general list of stocks. This is unusual and deserves careful study. In the long run, shares of small and young companies and shares of obscure companies have fared as well as, and perhaps better than, top-quality stocks. Accordingly, the rising prices for high-quality stocks, coincident with declining prices for other stocks, generally in the last 25 months, is noteworthy. To be specific, Standard & Poor's index of high-grade stocks increased 14.3%, whereas Standard & Poor's index of low-priced stocks decreased 33.1% during the period referred to above. The Dow Jones Index of 30 industrial stocks, which are mostly high-grade stocks of large corporations, increased 3.5%, whereas the general level of all stocks on the New York Stock Exchange decreased 11.4%. For the purpose of sampling how much the general list of stocks declined, we have studied the record of the first 100 common stocks chosen alphabetically which are listed on the exchange. This list, which naturally includes some high-quality, some medium-quality, and some low-quality stocks, is attached to this memorandum and is well worth reading. It shows that in this short space of time there have been wide variations with increases ranging as high as 52% and declines as great as 63%. 30 of these stocks increased, whereas 70 decreased in price. This period of about 25 months has been unusual, and perhaps unique in the history of American stock prices. The Dow Jones Industrial Stock Average has fared 14.9% better than a general list of 100 stocks chosen alphabetically. The index of high-grade stocks has fared better than the index of low-priced stocks by a full 48%. By examining the causes for this divergence, we may find clues as to how long the divergence might continue. One cause has been the institutionalization of investments, and another cause has been the widespread expectation of a recession in general business. By institutionalization, we mean that a larger than usual proportion of the total new money available for investment is coming in through insurance companies, trust funds, pension funds, profit-sharing funds, mutual investment funds, and various other institutions. One of the earliest influences of this nature was the large accumulation of investment funds in the hands of life insurance companies, banks, and similar institutions. Until recent years, such funds were invested only in mortgages, bonds, and preferred stocks. Therefore, the funds available for the purchase of bonds have been large, while at the same time the funds from other sources available for common stocks have been small. This situation has been one of the causes for the change in the ratio between bond yields and common stock yields. The excellent studies of the Coles Commission indicate that in the 68 years from 1870 to 1938, the yields of common stocks averaged 5.0%. whereas the average return was 4.2% on high-grade bonds and 4.6% on prime commercial paper for this same period. Now, high-grade bonds yield 3.1% and common stocks 6.0%. The ratio of stock yields to bond yields has increased from 119% for the 68 years ending with 1938 to 193% at present. In fact, During these latest 15 years, common stock yields have been very frequently more than twice as high as the yields on high-grade bonds. In recent years, an ever-increasing amount of institutional money has become available for the purchase of common stocks. Life insurance companies have been granted permission to invest part of their assets in common stocks. More recently, the same permission has been granted to savings banks. At long last, the laws of New York have been changed to permit trust funds, where the trust agreement is silent on the subject of investment media, to be invested partly in common stocks, and many other states have followed suit. Mutual investment funds, sometimes called investment trusts, have been investing in common stocks for more than 30 years, but the quantity of money coming in through this source is now vastly greater. Colleges and other public endowment funds are shifting gradually into a higher proportion of common stocks. Perhaps the greatest influence is the rapid rise of pension funds and profit-sharing funds in the last 2 years. Over $1 billion a year is now flowing into these funds, and the rate is increasing. Only a part of such funds is used to buy common stocks, but still, the total for this purpose is great. The men who manage these institutional funds are naturally cautious. When selecting common stocks, practically all of the funds flow into a small list of high-grade stocks of large and famous corporations. This has been the outstanding influence on stock prices recently. Because the supply of this kind of stocks is limited, the prices have been bid up at the very time when the prices of medium-grade and risky stocks have shown a declining trend. The divergence in trends for the different classes of stocks has been augmented, especially during the last 2 years, by the fear of a general business recession. The opinion has been widespread among investment analysts that a mild depression would begin soon, and some have thought that it would be more than mild. Therefore, these security analysts and many of the larger investors whom they influence have been shifting funds into the shares of companies whose earnings are expected to be stable and out of the shares of companies whose earnings might suffer temporarily during a general business recession. To a considerable extent, a recession has already been discounted in the stock market. Shares of many small companies and companies operating in cyclical industries are now selling at prices which are low not only in relation to prosperity earnings, but also in relation to the average earnings which may be expected during the next full business cycle. The fear of a business depression has endured for a long while, but by its nature, this influence can be regarded as temporary. If the expected recession does not occur, the fear may decrease, and if it does occur, investors are likely then to look ahead in anticipation of recovery. It is the nature of humanity that general fears and anticipations are constantly changing. On the other hand, there is no end in sight for the trend toward greater institutionalization of investments. Not only will the investments already made through institutions remain, but also there is likely to be a great increase, especially in the field of profit-sharing funds and pension funds. It has always been normal for stocks with a long record of stable earnings to sell higher in relation to earnings than is the case with the general run-of-the-mill stocks. The relation between price and earnings is called the price-earnings ratio, and this is one of the most important elements in the study of stocks. The price-earnings ratio for high-grade stocks is normally higher than the price-earnings ratio for low-grade stocks. Because of these factors, this spread is greater now than formerly. Because the trend toward institutionalization will continue, the spread may continue to be unusually wide by past standards. The question of whether the spread will remain wide is important for investors, but even more important is the question of whether the spread will grow still wider. A high-grade stock, like Union Carbide, is now selling for a little more than 20 times average earnings for the last 5 years, whereas a medium-grade stock like U.S. Plywood is now selling for less than 7 times average earnings for those years. Some low-grade stocks are selling for only 3 times earnings. Will this disparity increase? In some ways, a divergence like this tends to be self-correcting. Naturally, there is some limit to how great the disparity can get. The limited quantity of top-grade stocks may encourage even trustees gradually to leak further afield. Furthermore, those who do not have the position of trustees, when they see the great disparity now existing, may begin to sell their top-grade stocks to the trustees and use the proceeds for buying better bargains and better yields among medium-grade stocks. It is enlightening to notice that the disparity showed up first in the difference between bond yields and stock yields. After a while, this led to a general trend for institutions and trustees to include a few high-grade common stocks in their investment funds rather than only bonds. It is natural and proper for men acting as fiduciaries to be cautious, and so far they have been willing to purchase only top-grade common stocks. However, there may well develop a gradual trend toward seeking much greater values and greater yields than can be found among most top-grade stocks. Another situation that deserves close study is the fact that certain stocks, previously regarded as medium-grade, may gradually come to be regarded as top-grade. For example, in the 10 years from 1935 to 1944, Minnesota mining was regarded as medium-grade, and the price-earnings ratio averaged only 11. Now this stock is regarded by many as top-grade, and its price is over 23 times the highest earnings ever reported. To use Wall Street slang, there are a good many red chips now that may become blue chips within a few years. Of course, under certain circumstances, the prices of low-grade stocks increase much faster than the prices of high-grade stocks, sometimes many times as fast. For example, Norfolk and Western, which was regarded as a top-grade stock in 1941, sold as low as 44 7/8 in that year, and is now available at 40 7/8, whereas the price of St. Louis Southwestern, a low-grade stock, increased from 1.5 at that time to 222 at present. The price of Missouri Pacific Preferred, another low-grade stock, increased from 1/8 to 40 3/8. Conditions which lead to the popularity of low-grade stocks will occur again sometime, but this does not appear probable in the next few years. Finally, it is worth noting that a really long-term investor will fare better if he selects stocks with low price-earnings ratios, if all other factors are equal. For example, a stock purchased now for 20 times average future earnings will accumulate during the next 10 years $500 for the benefit of the other, either in the form of dividends or increased net worth, for each $1,000 invested. Whereas a stock purchased now at 7 times future average earnings will accumulate in the next 10 years $1,429 for the benefit of the owner. If you pay 20 times earnings for the shares of a company with a steady earning power, you may actually be taking more risk than if you pay only 7 times earnings for the shares of a company whose earning power is subject to fluctuations. To get the maximum combination of safety, income, and capital growth, investors should seek to buy stocks at low prices in relation to normal earning power. It is normal for high-grade stocks to sell for higher prices in relation to earnings than medium-grade stocks. The disparity has increased remarkably in the last 25 months. The unusually wide disparity may continue because most new money is flowing into stocks by way of institutions. For several reasons, the disparity is self-limiting. Investors should favor good-quality stocks, but those investors who are not trustees should be willing to pay only a fair and not an excessive premium for good-quality stocks. Best results in the long run are likely to come from searching out stocks of improving quality and stocks that are real bargains. The next memo can perhaps stand as the definitive illustration of the approach which John Templeton was taking to analyzing the level of the stock market during his years as an investment counsel. The contrast between his analysis at two different dates, 1950 and 1955, brings out clearly the different factors that contributed to his overall assessment. Note also the emphatic use of data to support and add weight to his arguments. August 1955. Templeton, Dobro, and Vance, Incorporated. 5 years ago I wrote and published in the August 10, 1950 issue of the Commercial and Financial Chronicle an article stating 5 lines of thought leading to the conclusion that stock prices were then too low. Now it is interesting to bring up to date each of these 5 lines of thought, which may help us to understand just how high stock prices are now. In the left column below, you will find the 1950 article in its entirety, and in the right column, facts and comments about the situation today. The comparison may help toward clear thinking, despite the rosy glow which now pervades Wall Street and Main Street both. Left column. How high is the stock market? 1950. The stock market is now dominated by the international situation. In the first 18 days after the invasion of South Korea, industrial stock prices declined 13.5%. Some people think that this was only the beginning of a greater downward trend caused by the prospect of excess profits, taxes, and price controls. Others think that this was only a temporary reaction in a long upward trend caused in part by inflation. Some light may be shed on this subject by studying the question of whether stock prices today are high in relation to intrinsic value or low. Historically, the market is in high ground. In May and June 1950, the Dow Jones Industrial Average was the highest in almost 20 years. Even now, the DJIA is about 208, whereas the average level of the last 30 years was only 143. On the other hand, the prices of secondary stocks are much lower. Standard & Poor's index of low-priced stocks reached a peak of 315 in the first week of February 1946, and this index is now only 151. In relation to earnings, stock prices are low. A record of earnings for 79 years is shown in Table 1. From this table, it is easy to compute that the average earnings for the last 30 years were $7.48, but current earnings are $19.90. In other words, earnings are 166% higher than the average of the last 30 years. Therefore, it is not surprising to find that industrial stock prices are 45% higher than the average of the last 30 years. In fact, if stocks should sell now as high in relation to current earnings as has been normal for the last 30 years, then the DJIA would be 388. Next, let us consider the subject of dividends. The average yield from dividends on industrial stocks has been 4.90% for the last 30 years, but the average yield today is 6.69%. At current dividend rates, stocks would yield 4.90%, the average of the last 30 years, if the DJIA were 283. Of course, there is a general opinion today that current earnings and dividends are abnormal. In fact, there are some people in Washington who say that current earnings of corporations are excessive. This is not a fair statement. It would be just as reasonable to say that current wage rates are excessive. Average earnings of factory workers have risen from a minimum $15.96 weekly 18 years ago to the current rate of $57.50 weekly, which is an increase of 260%. The increase in earnings of corporations has been roughly the same as the increase in gross national product of the United States. Before 1941, gross national product had never exceeded $107 billion, but the current rate is $263 billion. Gross national product is 117% higher than the average of the last 30 years, and a decline of only 18% would bring corporation profits down to the same percentage of gross national product as has been normal for the last 30 years. Changes in gross national product are roughly proportional to the change in the sales volume of corporations. Accordingly, it appears that profits of corporations are only a little larger in relation to sales volume than has been normal for the last 30 years. It appears unlikely that gross national product will be any smaller 5 or 10 years from now than it is today, and accordingly, there probably will be no decline in the total sales volume of corporations. It is not possible to have a decrease in gross national product unless there is a decrease in employment or a decrease in the output per man-hour or a decrease in the price level. Actually, it appears probable that all three of these factors will increase rather than decrease. Output per man-hour will increase with increasing use of machinery. Total employment will probably increase because of the growth of population. The expense of military preparation points toward an increase in the price level. Since the invasion of South Korea, investors have been worried about a possible reduction in corporation earnings caused by price controls and excess profits taxes. It appears that these factors will cause some reduction. But also, it is interesting to notice that during the years when excess profits taxes applied, from 1940 through 1945, the average annual earnings of corporations were 5% greater than the average annual earnings of the 4 years 1936 through 1939, which were taken as the base period. Also, investors have been fearful concerning increased government controls and the trend towards socialization. These two are serious problems, but it is interesting to notice that stock prices in European countries are considerably higher than they were 12 years ago, even though these nations have traveled much further than the United States on the road to socialization. The change in the level of stock prices can be compared with the change in the volume of liquid assets held by individuals. Unfortunately, statistics on the amount of liquid assets are not available for the earlier years. But 11 years ago, in 1939, the liquid assets of individuals were only $50 billion, whereas today they are $177 billion, an increase of 254%. By comparison, the increase of 48% in stock prices from 1939 up to today appears small. Another way to approach the question, how high is the stock market, is to study the value of the assets in back of these stocks. Corporations pay out in dividends only a part of the earnings, and the other part which is retained adds to the assets per share and increases the normal future earning power. This has caused the average net worth per share stated on the books of corporations to increase 76% in the last 15 years. The present book value per share is 46% higher than the average of the last 24 years. Furthermore, because of the inflation which has occurred in the cost of buildings and machinery, the assets could not be replaced for the figures shown on the corporation's books. Based on earnings retained in excess of dividends and modified to allow for changes in the purchasing power of the dollar, the Templeton, Dobro, and Vance Index of Replacement Costs for the last 28 years was 161.6, whereas the current replacement cost is 282.3, a difference of 75%. Since replacement costs are 75% higher, it is not surprising that stock prices should be 45% higher, as stated above. Industrial stock prices were first publicly quoted in 1871, and since that time there has been a long-term upward trend in stock prices. In the 10 years before the First World War, 1905 to 1914 inclusive, they averaged 85.3, an increase of 84%. Since the Second World War cost the United States about 5 times as much as the First World War, it could be logically argued that it should have caused an increase in the range of fluctuation of more than 84%. However, in the 10 years before World War II, the average level of the market was 131 in terms of the DJIA, and it is only 59% higher now. Although the stock market is in high ground historically, the figures quoted above indicate that current stock prices are still below normal in relation to A. Earnings, B. Dividends, C. National income, D. Liquid savings of individuals, and E. The relatively permanent changes which have been caused in stock prices in the United States and also in other nations by previous great wars. Right column. How high is the stock market? 1955. The stock market is now dominated by talk of a new era. The pessimism and fear caused by the Great Depression and by the war, which had an almost continuous influence on the minds of investors and businessmen for 20 years, have evaporated at last. One of the Washington newsletters states, "The most surprising thing our survey turned up, however, was a great unanimity of opinion. Bears were very conspicuous by their absence. Even the doubters think 1956 will top or match 1955. This itself is a warning signal. Further good news could not cause many more people to become bullish, because so many people are bullish already. Conversely, however, any bad news causing a few of the many bulls to change their minds would increase considerably the number of bears. Stock prices are far higher now than ever before. The Dow Jones Industrial Average is about 460, whereas the average level of the last 30 years was only 174. Standard & Poor's broad average of 420 industrial stocks is now 86% higher than the 1929 peak. In relation to earnings, stock prices are now very high. It now appears that earnings for this year will be just about 15% more than they were in the year 1950. Meanwhile, the Dow Jones Industrial Average has risen from 208 to 460, which is a rise of 121%. The figure of 388 for stock prices mentioned 5 years ago looked very high indeed at the time, but now stock prices have not only reached but exceeded this figure by 19%. In relation to dividends, also stock prices are now very high. The average yields from dividends on industrial stocks has been 5.00% for the last 30 years, but the average yield today is 3.63% on Standard & Poor's average. At current dividend rates, stocks would yield 5.00%, which is the average of the last 30 years, if the DJIA were 388. Gross national product is now estimated at an annual rate of $380 billion. This is 130% higher than the 30-year average. In other words, stock prices are now 164% above the 30-year average, whereas gross national product is only up 130%. This means that stock prices are abnormally high, because for several good reasons the long-term upward trend in stock prices has been normally less strong than the trend of gross national product. The prospect for further increases in gross national product discussed in this article 5 years ago was largely ignored by investors at that time. Now, the glorious and ever-expanding future for American corporations is a favorite subject for speakers and writers. This growth is not a new factor in the investment equation. It has been going on for more than a century. Because of this growth, it has been normal for industrial stock prices to increase at an average rate of 3.2% annually, compounded. If stock prices had risen only this much, we would not say that they were too high. But it is prudent to note that, taking the last 30 years as a base, this rate of growth would indicate that the Dow Jones Industrial Average should now be 280, rather than 465. Again, taking the last 30 years as a base, and a normal increase in stock prices of 3.20% per year, We compute that 465 on the DJIA might be considered normal in 1971, but not in 1955. In other words, present stock prices may be discounting the future a long way ahead. There is no longer a surplus of liquid assets in the hands of individuals. In the 5 years from 1950 to 1955, stock prices increased 121%, whereas liquid assets held by individuals increased only 18%. Share prices are much higher now than usual in relation to the average net worth per share stated on the books of corporations. The Templeton, Dobro, and Vance Index of Replacement Costs averaged 197 for the latest 30 years, whereas the current replacement cost is 365, a difference of 85%. This might justify a rise in stock prices of 85%, but stock prices have risen 164%. As stated 5 years ago, it seemed reasonable that the Second World War would cause an increase of at least 84% in the range of fluctuation for stock prices as compared with pre-war. 5 years ago, stock prices were only 59% above pre-war, whereas now stock prices are 251% above. The conclusion of this study is totally different now from what it was 5 years ago. Not only are stock prices far higher than ever before, but also stock prices are now A. Earnings, B. Dividends, C. National income, D. Liquid savings of individuals, and E. Previous changes in stock prices caused by wars. No one can say that the risk in buying or holding common stocks today is greater than at any time in the last 18 years. Global investing. If John Templeton is known for any one thing, it is as the man who persuaded the American public that it was both safe and profitable to invest outside their own borders. Today, when global stock markets have become a reality, it is easy to forget how difficult it was to change the parochial mindset of the ordinary investor. At the time, however, it must have seemed like an uphill challenge. In 1954, Templeton set up the Templeton Growth Fund, which was to become one of the first diversified global stock investment funds of any note. For tax reasons, the new fund was domiciled in Canada, but could be bought by investors in the United States. A number of other companies launched Canadian-based funds at the same time in an attempt to take advantage of a recent favorable tax ruling in the United States. The same year, he sent a note to his clients explaining why Canadian stocks were attractive at current prices. Perhaps he also calculated that if investors were not prepared to invest just across the border in North America, it was unlikely that they would be willing to do so anywhere else. This is the first recorded example we can find of Sir John recommending overseas stocks to his clients. The quantity of good Canadian stocks. Several investment trusts are now being formed by Americans who wish to invest in Canada. These trusts plan to pay no dividends, and therefore the American owners will have no income tax on the accumulation of dividend income and capital gains. Knowledge of the advantages of such investments is reaching more men of wealth, and the demand for shares of these new trusts is increasing. In fact, this appears to be the beginning of a new trend that may continue to develop for several years. The question has been raised concerning the effect of this trend on the prices of Canadian stocks. The purpose of this memorandum is to provide some information on that subject. If all of the Canadian trusts now being discussed are eventually formed, it appears that something in the neighborhood of $100 million will become available for investment in Canadian stocks. Of course, this is a large sum of money, but it may have little effect on prices at present because the quantity of good stocks available in Canada is so great. For example, Aluminum Limited alone now has over $500 million worth of common stocks outstanding. Imperial Oil shares have a quoted market of almost $1 billion. International Nickel has over $600 million of stock outstanding, not including the preferred. There are many others. A list is attached to this memorandum that shows 25 stocks of Canadian companies, each of which has a market value of over $100 million. The amount of cash that may become available through these new investment trusts, in the neighborhood of $100 million, is less than 0.5% of the gross national product of Canada, which was over $22 billion last year. Also, it is interesting to compare this new form of investment with the other forms of investment by Americans and other foreigners in Canada in previous years. For example, we estimate that in the year 1953, the inflow of long-term direct investment was about $385 million, and new foreign portfolio investment was about $322 million. Canada needs this new investment. Canada's current trade transactions with the United States last year established a deficit of $984 million. This deficit was offset in part by the investments of Americans in Canada, as mentioned above. It is normal for young, growing nations to have a continual large inflow of capital for investment. It is interesting to notice that the inflow of investments has not caused Canadian stocks to sell too high in relation to American stocks. Attached to this memorandum is a chart, not shown, that shows an index of Canadian industrial stock prices compared with American stock prices for the latest 5 years. This shows actually that in relation to American stock prices, Canadian prices are now lower than usual. In young and growing nations, it is customary for corporations to distribute in dividends only a small share of the earnings. However, the attached tabulation shows, not shown, that the 25 Canadian stocks listed now have an average dividend yield of 4.15%, which compares with a yield of 4.81% now on the Dow Jones Industrial Index of American stock prices. Mr. Murray Shields, talking before the American Management Association last month, made the following interesting comment about Canada. There is reason for confidence that the quarter century from 1952 to 1977 will bring an expansion in Canadian population from 14 to roughly 28 million and an increase in production from $1,595 to $3,000 per capita, which would lift the total production of goods and services from $23 billion to $83 billion in 1952 Canadian dollars. Of course, in 1977 dollars, this estimate would be even greater. Canada encourages investors, and political conditions will probably continue to be favorable in Canada. For the 8th consecutive year, Canada has had a surplus in the national budget. This has helped Canada to reduce its national debt from 113% of gross national product in 1946 to 46% of gross national product on March 31st, 1954. In the mid-1950s, Sir John Templeton made a long trip to Europe, during which he visited 10 countries. He reported back on his impressions to his clients. His letters make fascinating reading today, not least because one can measure the accuracy of his impressions with the benefit of hindsight. They provide a powerful insight into the way he thought about the global investment scene. Note in particular his ability to marry specific examples to general observations, and the clarity of the thinking and expression. Knowledge about what was happening in Europe would have been low. More examples can be found in the Templeton Memos page of the Independent Investor website. At the time these letters were written, the European Union was still a gleam in the eye of a small group of politicians and bureaucrats. They dreamed of unifying Europe, partly in the belief that this would be economically advantageous, but primarily as a means of preventing a further outbreak of war. 2 world wars had devastated the continent of Europe, leaving many cities in a state of complete ruin. Every country faced the challenge of economic and political regeneration. As an investor, comparing the valuations of European and U.S. stocks, and sensing the growth potential, Templeton could see that this was likely to create attractive investment opportunities. Observations from the viewpoint of an investor. Letter to clients, May 1955. Spain. The lion's share of the good investment opportunities are found in the United States. Therefore, American investors tend to be nearsighted and insular. Such narrowness of vision can be dangerous. I do not mean that Americans should put much money into foreign shares. There are many good reasons for preferring U.S. shares. I mean only that good judgment is the foundation of investment success, and the risk of error is reduced if the investor's judgment is not based narrowly on knowledge of investment comparisons, present and past, in the United States alone. The future for investors in the United States may be just a repetition of the past, but also it may not be. My visit to the tomb of Columbus in Seville reminds us that Spain once flourished as the economic and financial capital of the world. It is not so now. The national income of Spain is less than 1/40th the national income of the United States. It is thought-provoking to notice that, from the 1948 average, share prices in Spain are up only 5%, whereas in the United States they are up 138%. This is all the more curious in view of the fact that Spanish national income is up 136%, which compares with an increase of only 37% in the United States. Because a terrible drought in 1953 ruined the wheat crop and olive crop, and because a severe freeze in 1954 greatly reduced citrus production, which is Spain's chief source of foreign exchange, the nation has been subject to strong inflationary pressure. The inflation led to a nationwide increase in salaries and wages during the 1953-1954 winter, ranging from 30% to as high as 45% in some sectors, if social benefits for workers are included. The common people of Spain are poor but gay. The church is very strong, and political conditions appear stable. Stock trading is active, especially through the facilities of the large banks. Shares of 78 established corporations are traded on the exchange in Madrid. There are also stock exchanges in Bilbao and Barcelona. Some of the favorites with investors are as follows: Banco Hispano Americano, branch banking, yield 2.15%. Hidroelectrica Iberia, electricity, yield 4.15%. Sevillana Electricidad, electricity, yield 5.13%. Ebro Azucarera y Alcoholes, sugar, yield 3.61%. Tabacalera, tobacco, yield 4.01%. Españolo de Petróleos, oil, yield 2.17%. Altos Hornos de Vizcaya, steel, yield 4.25%. Telefónica, telephone, yield 3.02%. The yield on these stocks is less than the average U.S. stock yield. However, government bonds in Spain yield about 3.90 versus 2.80% in the United States. This is the first of several brief and private summaries I plan to write after talks with bankers, investors, and corporation executives in various countries in Europe. Observations from the viewpoint of an investor. Letter to clients, June 1955. Italy. Italy is still poor. The national income averages only moderately over $300 a year per capita, whereas in Switzerland it is $1,000 and in the United States about $1,900. The average wage is approximately $2 a day, but the employer must pay about 30% more to the government for pensions and other workers' benefits. Even so, the present per capita income is the highest in the history of Italy. It is estimated that the standard of living is 1/3 better than pre-war. The rate for foreign exchange has remained steady for 6 years at 625 lira for $1. Taking 1948 as a base, industrial production has increased 76%. The cost of living is up only 21%. Most interesting of all, the average price of common shares is up 158%, which is greater than the rise of share prices in the United States. In most European countries, information about corporations is both scarce and unreliable. The quantity of information available to investors in Europe is only a very small fraction of that available in America on U.S. stocks. This lack is especially obvious in Italy. Even the chief of the stock market department of a large bank often knows only the dividends and not the earnings of even the most popular stocks. One of the reasons for lack of information is widespread tax evasion. Most corporations understate both earnings and assets to avoid taxes. Most citizens omit dividends when reporting their income, and practically all omit capital gains. This is not regarded as dishonest as it would be in America. The rare citizen who reports all his income is regarded simply as a fool. The government has tried in recent years to change this attitude toward taxes, and further steps are under consideration. However, so little progress has been made that many tax collectors still use the informal rule of 3. This means that the collector assumes that the taxpayer has greatly understated his income and therefore multiplies the stated income by 3 to estimate the actual income. This attitude does not result from high tax rates on income. In fact, tax rates are low by U.S. standards. A man with an annual income of $15,000 would pay only about 10% income tax. The maximum income tax rate of 50% is not reached until the income is over 1,000 times the per capita average income. Corporations are subject to a variety of taxes, but for the largest corporations it usually works out that they pay about 50% of their reported income. The interest on government bonds is tax-exempt for all taxpayers. The pattern of investment yields in Italy is especially thought-provoking for an American. In the United States, yields on industrial stocks at 4% now are low by historical standards, but they are still one-third better than the yields on any Treasury bonds or high-grade industrial bonds, and they are not much different from the yields on first mortgages. Industrial shares in Italy now yield even less than in the United States, but by contrast, the rest of the yield pattern is about like this. Treasury bonds, 6%. Corporation bonds, 6.5%. Public utility common shares, 7%. Bank loans, 7.5%. Mortgages bought by banks, 11%. And first mortgages bought by private citizens, 15% or even more. The mortgage yields are especially peculiar in view of the fact that the principal is payable in full in 2 years or less. Banks usually lend only 30% of the sale price of the mortgaged house or apartment, and private citizens only 50%. For the purpose of illustration only, I will mention some of the investment facts about Montecatini, which is aptly described as the DuPont of Italy. Montecatini sales last year were 126 billion lira, and the profit 10.3 billion after paying an almost equal amount in taxes. 9.7 billion was distributed as dividends. It is customary in Italy to distribute a greater part of reported earnings than in the United States. Montecatini shares now sell for 2,600 lira each, and the annual dividend is 115 lira. The 4.4% yield on Montecatini is above average for Italian industrials. There are now restrictions on the transfer of cash into or out of Italy for investment, but such restrictions are regarded as temporary. If Italian shares are bought with U.S. dollars and then sold, 1/2 of the original investment can be transferred back to the United States 2 years after purchase, and the other half 2 years later. The gain, if any, must remain in Italy. Dividends and interest can be transferred up to a maximum of 6% annually. Excess income and gains are put into a so-called foreign account at a bank and can be reinvested or spent in Italy. Alternatively, the funds in a foreign account can be sold by one foreigner to another. Yugoslavia. Turning now to Yugoslavia, this country is interesting to an investor, primarily to see what can happen when a nation is taken over by communists. Yugoslavia is a police state. Thousands still live in terror. Various local elections are held every few days, but of course elections are a mockery when no one dares speak a word against the ruling gang. Personal capital has survived in Yugoslavia in only 3 forms. 1. Farms up to a maximum of 25 acres if worked by the owner. 2. Small shops up to a maximum of 5 employees. 3. Homes if occupied by the owner. There is one bank. This bank holds cash deposited by citizens and makes loans at 6% to peasants and to state-controlled cooperative enterprises. The government occasionally sells bonds to the workers, but this resembles more a special kind of tax rather than a free investment operation. Russia also has recently sold a small bond issue to its workers, which serves the purpose of diverting more funds to expansion of heavy industry and away from private consumption of goods. The leading hotel where I stayed in Ljubljana, the capital of Slovenia, can serve as an illustration of business in Yugoslavia. It is run by a director appointed by the state and by a committee of 8 employees elected by the other 116 employees. A traveling state inspector visits the hotel every 2 weeks and is the real authority on all important matters and plans. The communists call this a worker-owned cooperative business. But actually the workers have no rights of ownership except the right to share in bonuses up to 25% of net profits. The other 75% is taken by the state as a tax. The previous owner was not executed as an enemy of the state, but received nothing for his hotel except vague talk about compensation eventually. He receives a nominal monthly wage as an advisor. Yugoslavia is dreadfully poor. The poverty is universal. At the free market rate of 500 dinars to the dollar, the national income is only $100 a year per capita. Nearby Switzerland, with similar topography and resources, has 10 times as much income per person. It is strange to drive the roads of Yugoslavia and never see a privately owned auto. There are a few trucks and autos owned by cooperative businesses, but only a few. It would stamp a man as an enemy of the state to have enough money to own an auto. The neighboring countries are overcrowded with motor scooters and bicycles with little motors, but I did not see even a bicycle motor in Yugoslavia. The price of a bicycle is about 5 months' wages for the average citizen. Templeton's successful foray into the Japanese stock market from the late 1960s onward was to help make his name as a global investor. What did he see in Japan that few other foreign investors were able to see? It was not simply, as his assistant Mark Holowesko observed, that stocks were cheap, though they certainly were that, with household names such as Toyota and Sanyo selling at one point for low multiples of current year earnings. He had also observed the fact that the Japanese were an exceptionally hard-working people, with a culture of saving, and that its policymakers were in the process of fashioning a successful export-led industrial strategy. This note to investors shows that Templeton was already enthusing about Japan's potential before 1960. Japanese stocks. Letter to clients, 1959. Japanese products are capturing export markets throughout the world. Many Japanese products are being imported into the United States in large volume. Japan is winning the competitive struggle in these cases partly because of low wages. The difference in wages is apparent from the fact that the gross national product is $305 per capita in Japan, compared with $2,600 per capita in the United States. Japan is a nation of 92 million people whose livelihood depends upon their ability to export a major share of their products. In the last decade, these industrious people have developed great skill in making radios, ships, dinnerware, cameras, and numerous other products. By importing the newest types of machinery, their output per man-hour has increased. It is significant that Japanese cameras are now selling even in Germany, which was long the lowest-cost producer of high-grade cameras. From 1951 until the end of 1958, industrial production in the United States increased 18%, whereas industrial production in Japan increased 173%. Both Japan and the United States have been troubled less by inflation in these years than many other nations. The cost of living, which is a measure of inflation, increased 11% in the United States and 24% in Japan. From 1954 until today, the cost of living in Japan rose only 1% a year. Only 10 years after Commodore Perry landed in Japan, stock exchanges were founded in Tokyo and Osaka. In 1948, Japan established a government agency called the Securities Exchange Commission to regulate its investment markets. The most widely used index of Japanese stock prices is called the Dow Jones Index. The activity on the Tokyo Stock Exchange has been averaging over 50 million shares a day this year. Japanese bonds of good credit, maturing within 4 years, now sell to yield 8%, whereas similar bonds in the United States yield 4.2%. Japanese stocks now yield 4.35%, whereas stocks in the U.S. Dow Jones Industrial Average now yield 3.29%. The Japanese Stock Journal, published weekly in English, is sent by airmail to its subscribers in the United States, and this journal gives prices and information about 500 stocks. U.S. residents may purchase Japanese stocks freely in U.S. dollars exchanged at the official rate of 360 yen for $1. If the purchases are registered in advance with the Japanese government, the interest and dividends can be converted into U.S. dollars and transmitted to shareholders without delay. Capital and capital gains cannot be converted back into dollars promptly. But 2 years after a U.S. resident purchases a Japanese stock, he may convert back into U.S. dollars at the official rate, 20% each year. If the world trade position of Japan continues to strengthen, this rule about delay in converting capital back into dollars may later be eliminated. The tax treaty between the U.S. and Japan provides an unusual and remarkable advantage for U.S. purchasers of Japanese stocks. The treaty provides that Japan will withhold no tax on dividends. Each $100 in dividends is converted and transmitted in full to the U.S. shareholder. The shareholder may report the dividend plus 25%, which is $125, on his federal income tax return. And then, after computing his U.S. income tax, he is allowed to deduct $25 from such tax. For example, let us assume that a U.S. shareholder in the 30% top tax bracket receives $100 in dividends from U.S. stocks and $100 from Japanese stocks. His net tax on the U.S. dividends would be $26 after the usual dividend received credit, while his net tax on the Japanese dividends would be only $12. Industrial output may continue to expand in Japan at a rate far greater than that in the United States. Companies that produce quality products for export at low prices can grow faster than the total industrial production of Japan. Our studies of the Japanese economy indicate that the best growth industries will include electronics, electrical apparatus, automobiles, drugs, dinnerware, and cameras. Within these industries, the companies with the best growth trends include the following 5. Toyota Motor, Matsushita Electric, Sanyo Electric, Sankyo Pharmaceutical, Riken Optical. Toyota Motor is Japan's leading automaker. The company is producing 6,500 vehicles a month, which is 43% of total Japanese production. Its capacity is 8,000 a month, and this will soon be increased to 20,000. Profit has tripled in the last 5 years. In the first 3 days after the Toyopet car was shown in New York, 100 were sold, and nearly 100 auto dealers from numerous states applied for the sales franchise. Japanese buyers of the Toyopet Crown must wait 3 months now for delivery. The Japanese government's 5-year plan, announced in 1957, provides for an increase of 180% in automobile production. Matsushita Electric Industry is a leading producer of radios, television sets, household appliances, and electronic tubes. It has recently developed facilities for producing 800,000 transistors a year. On May 31st, it will split its stock 3 for 2 and issue 1 million new shares for cash. The dividend on the new stock is expected to be 10 yen a year, which is equivalent to 15 yen on the present shares. Net profit has increased in every one of the last 10 semi-annual fiscal periods. During this 5-year period, profits more than tripled. Sanyo Electric has an equally strong growth trend. It produces a wide variety of electrical and electronic apparatus and household appliances. In the last 5 years, profits have averaged 6.7% of sales and 64% of capital. The capital has grown from 400,000 to 3 million yen. Sankyo Pharmaceutical is the most rapidly growing of the major drug firms and is now second largest in Japan. It exports drugs throughout the East and also in Europe. It has technical assistance contracts with leading drug makers in the United States, Denmark, Switzerland, and France. The share price is 6.4 times earnings, whereas the price of Merck shares now is 31 times earnings. Riken Optical has the strongest growth trend in the camera industry and has now become Japan's leading producer. In the semi-annual fiscal period ended March 1959, profits were twice as high as in the preceding period, and the stock will be split 3 for 2 in June. In conclusion, it is significant that only 1.59% of Japanese stocks are held by foreigners. Investments in Asia are not popular. The Japanese rule, which prevents prompt repatriation of capital, causes U.S. investors to hesitate. Conservative investors quite properly feel safer with investments at home. Crises and world events. The Cold War was won at the end of the 1980s when the Soviet Union collapsed under the weight of its own contradictions. It is salutary to remember, however, that for most of the 40 years that John Templeton was actively managing money, the threat of a nuclear war between the Soviet Union and the United States and its European allies remained a real and ever-present concern. It was something that he consistently highlighted as the biggest threat to his otherwise broadly optimistic outlook for the United States. The end of the Second World War was followed by a series of political and military crises that heightened investors' sense of insecurity. In 1950, the United States and the Soviet Union did confront each other in the Korean War. John Templeton wrote a number of memos to his clients in the run-up to the conflict. October 1949, in case of war. I hope that there will be no war. This natural feeling appears to dominate Wall Street thinking. Perhaps that is why almost nothing has yet been written on the subject of how to protect wealth in case of war. But an investment counselor must avoid wishful thinking. It is his duty to plan ahead, to try to guard against each danger, however remote, whether the origin of the danger is economic, political, or military. In the military field, there now appear to be only 3 possibilities. 1. No war. 2. war which the United States wins. 3. War which Russia wins. If we could see into the future, we would know which of the three possibilities to use as the basis of investment policy. Without this foreknowledge, we have no choice but to try to protect against all three at once, insofar as that may be possible. It is helpful to study the vicissitudes of investors in the United States from 1914 to 1921, and again from 1939 to 1946. But this time the conditions are likely to be very different, because the nature of the next war, if any, is likely to be very different. Accordingly, we must ponder also the vicissitudes of investors during those years in England, France, Italy, Japan, Germany, and Russia. When war began in 1939, prices on the New York Stock Exchange rose 15% in 2 weeks, and then declined 41% in 27 months. After the Japanese attack brought the United States into the war, stock prices declined 9% in 2 weeks, and then steadied. In case of war with Russia, nothing so mild as this experience should be expected. With universal desire for peace among the American people, it is most unlikely that the United States will strike the first blow. The chances are that if a war occurs, it will begin with a surprise attack by Russia. Stalin would be foolish to attack France or England first, because that would give the United States a chance to mobilize and launch an atomic attack in retaliation. It seems sensible to assume that the first blow will be an attack against American cities. Probably the blow will not be preceded by threats and diplomatic tension, but rather by false words of friendship, in order that the victim may be totally surprised. The atomic bomb puts an enormous premium on surprise. In previous wars, the aggressor could not possibly strike a decisive blow the first day, except against a very small nation. Now it is at least conceivable that the victim could be so crippled in the first hour that it would no longer be an even match against the aggressor. The original atomic bomb at Hiroshima killed 71,000 and injured 68,000. If the new bombs are twice as powerful, and if 200 could be brought into cities secretly and exploded about the same time, the mortality might be 28 million. There is no way to predict the date of an attack, but it is most unlikely that Russia yet has a stockpile of atomic bombs. Therefore, an attack within the next year is unlikely. This gives us time in which to prepare protections calmly and carefully. The worldwide communist organization is many times as large as the Nazi Fifth Column was in 1939. And using atomic and bacteriological weapons, this secret force may be more destructive than the Russian Air Force and submarines. In case of war, the stock exchange might remain closed a long time. Some bank records might be destroyed. Wartime taxes and wartime rent and price controls are likely to be imposed immediately and in more drastic form than heretofore. Non-essential businesses might be closed promptly for the duration. In other words, after war begins, it may be too late to think about rearranging your assets. On the other hand, two facts greatly complicate the matter of trying to rearrange your assets properly in advance. In the first place, it is possible that there will be no war, and in the second place, even if there is a war, there is likely to be no advance warning. Whether there is or is not any overt war, the investor should seek some protection against erosion in the value of the dollar. Without war, the gradual and intermittent trend toward inflation, which has existed in America for 17 years, is likely to continue because of repeated wage increases and frequent deficits in the federal budget. Federal finances already strained by one world war might not be able to stand another. In case of war, government expense would be vastly greater than receipts. Goods of every kind would be scarce. Such is the basis of inflation. Inflation was the result of war in China, Greece, France, Italy, and elsewhere. Owners of cash or bonds in those nations found that after the war, such assets had only negligible value. This means that, whether there be war or peace, it is a reasonable precaution in planning an investment program to keep the major part of your assets in equities, such as common stocks and real estate, rather than in cash or bonds. During a war, rent controls may make rental property temporarily unproductive, and wartime taxes may temporarily restrict the dividends on common stocks. But when the war is over, the owner will still own a valuable asset. Some forms of property, such as bridges and city real estate, may be subject to extensive damage, but some other form of property, such as oil in the ground, are almost indestructible. It is an old axiom that possession is 9 points of the law. In normal times this may be an exaggeration, but not in times of national crisis. At such times, a house in which you live is a safer asset than a bank account. But of course there are reasonable limits to this idea. For example, a man of calm judgment will not, through emotion or fear, buy diamonds and bury them in the cellar, because this would deprive him of dividends on the funds. Also, even if a war did occur, disruption of the De Beers syndicate might remove the scarcity value of diamonds. The precautions which are justifiable now are simply those which increase the degree of possession of your assets without detracting from the value of the assets or pursuit of your career in peacetime. Precaution against war is an influence which bears on investment planning in ways too numerous to mention in this brief paper. For example, 1. If two stocks are equally good bargains, you may choose the shares of the company in an essential industry rather than shares of the company whose work is non-essential. 2. If your stocks are held in the vaults of your broker or your bank, in some cases you might ask the custodian to keep them registered in your name rather than the name of a nominee, if that would cause no inconvenience. 3. If other factors are equal, you may choose shares of a utility that has numerous properties in small towns, rather than a utility with all assets concentrated in a city like Detroit. The sensible precautions against the risk of war have been kept in mind when planning investment programs for our clients, along with the other major risks facing investors in a rapidly changing world. This will receive increased emphasis in the coming year. He who succeeds in preserving assets for the next 20 years needs a broad viewpoint and an open mind in matters of economics, politics, and atomic science. June 26, 1950. News from Korea. Investment Council clients of Templeton, Dobro & Vance, Incorporated, with few exceptions, follow carefully prepared, long-range programs of the non-forecasting type. Accordingly, there is no need for them to make any purchases or sales when unexpected news upsets the market as it did today. From a long-range viewpoint, stock prices are still not too high. In fact, they would have to go up over 10% from today's level before they would even be considered normal. However, because the stock market was upset today, we thought that clients might be interested in hearing from us on the subject. Usually, when unexpected news causes the stock market to decline sharply, the first day does not represent the full extent of the movement, and it would not be surprising if the market is unsettled until the situation in Korea is resolved one way or the other. If, however unlikely as it is, a major war should materialize, investors should remember that in all countries, at all times, war has been an inflationary rather than a deflationary influence on the long run. Of course, we will be watching this incident in Korea, along with the multitude of other factors which must be considered in the management of your investments. June 27, 1950. Another war scare. After the news last weekend from Korea, the Dow Jones Industrial Average declined 10.41 points on Monday. On Tuesday afternoon, it was announced that President Truman has dispatched units of the fleet to Korean waters, and on the stock exchange, the high-speed ticker was as much as 20 minutes late in reporting transactions. Now, at 2 o'clock, the DJIA has declined 5.56 points from yesterday's closing level. The stock market has behaved in somewhat the same manner on numerous occasions in the past. The day after President Truman was unexpectedly re-elected in November 1948, the DJIA declined from 189.76 to 182.46, and the decline continued until it reached 171.20 on November 30th and then rallied moderately for several months. When the Dow theory gave a bear market signal on the first day of September 1946, the DJIA declined from 189.19 to 178.68. 11 weeks later, the market established its lowest point at 163.55, which proved to be the lowest point for the next 2.5 years. On the day after the attack at Pearl Harbor, the DJIA declined from 116.60 to 112.52. The lowest point of that movement was reached 15 days later at 106.34, after which the market rallied for 3 weeks. On May 13, 1940, at the time of the fall of France, the DJIA declined from 144.85 to 137.63. The lowest point of this decline was established 4 weeks later at 111.84, which was lower than at any time in the following 18 months. On September 1, 1939, shortly before England declared war, the DJIA declined from 134.41 to 127.51 and then rallied the same day to show a net profit at the close of the market. Within 8 days thereafter, the market had risen from 135.25 to 155.92, which is 15%. When Hitler invaded Czechoslovakia in March 1939, the stock market declined gradually from 152.28 on March 10th to 121.44 on April 8th. But although a world war started 5 months later, the market remained above this war scare low point for the next 2 years. It is interesting to note that the wide decline in stock prices yesterday took almost $4 billion off the paper value of all stocks on the stock exchange. However, the total shares which changed hands yesterday represented only 0.07% of all the shares listed on the exchange. Also, it is interesting to reflect on the fact that, whereas 3,910,000 shares were sold yesterday, there were also 3,910,000 shares bought yesterday, and possibly the purchasers may be more intelligent than the sellers. Of course, it is unlikely that any major shooting war will result from the current situation in Korea, but it is interesting to remember that every major war has been an inflationary rather than a deflationary influence. In every nation where such information is available, stock prices have always fluctuated in a higher range after the war than they did before the war. At a time when the stock market is upset, as it was on Monday and then again today, those investors who follow carefully prepared long-range programs of the non-forecasting type have no cause for concern. Such programs are designed to profit from stock market cycles without the need for predicting such cycles. It is not necessary to be lucky in guessing unexpected events, and when such events occur, it is not necessary to make any guesses about the short-term effect on the stock market. Such contingencies are provided for in a carefully prepared program. Peace of mind is one of the byproducts of a good program. Under such programs, the investment in common stocks is reduced only when the market rises above normal. Therefore, no selling of stocks is called for at present. At the close yesterday, the market was about 11% below normal. This is not low enough to call for any purchasing of additional stocks. It does not appear likely that the market will decline enough to call for buying any more stocks than have already been purchased, which purchases were made in the bear market that terminated last year. But if it should, clients who have been following such long-range programs have funds in their conservation sections for use in making such purchases. Future prospects. John Templeton was always happy to talk, and usually enthused, about the future prospects for the United States and what they might mean for the benefit of his investors. It was his good fortune to be born and live his life during a period that saw the United States become the world's dominant economic and military power. He was at pains to convince his clients, and later investors in his funds, not to be deterred from their investment plans by bear markets, recessions, or other episodes of bad news. His technique was to use detailed statistics and examples from history to show that setbacks were invariably temporary. Another recurrent theme was the inability of economists or forecasters to predict economic or market setbacks before they happened. We reproduce some examples of his forward-looking pieces here. The first, a memo to clients, from March 1953, given more than 35 years before the last, a speech to clients of the Templeton business at the time of the severe 1990 to 1991 recession. References to charts that were excluded in the publishing of this book will continue in the same manner for the purposes of this audiobook. March 1953, 15 years of increasing prosperity. Business history. With regard to business and investments, the years from 1938 to 1952 were truly remarkable. The last real depression in the United States ended 15 years ago in March 1938. At that time, over 11 million people were unemployed. Then, in that month, Hitler invaded Czechoslovakia and started a chain of events which has caused vast changes in business and investment conditions. The extent of these changes is not generally understood. In 1938, gross national product of the nation was only $85 billion, whereas today the current rate is $360 billion annually. The output of the nation measured in dollars is more than 4 times as great as it was 15 years ago. Of course, the value of the dollar has changed greatly also. This change can be measured by the fact that the index of the cost of living has increased 88%. The most widely used index for production in terms of physical units is the Federal Reserve Board Index of Industrial Production. This index is now 163% above its average level for 1938. The business history during this 15 years of increasing prosperity is measured by the figures in Table 1, not shown. In 1938, 44 million people were employed. Today the total is 61 million, not including those in the armed forces. One of the greatest changes that has occurred is that of wage rates. Average earnings of factory workers increased 206% between 1938 and 1952. Bank deposits and currency increased greatly, which contributed to general inflation of prices. The increase from 1938 to 1952 was 232%. Most of this increase occurred in the first 7 years. When the war ended in 1945, the increase had been 195%. Since the end of the war, the increase in bank deposits and currency has been only 13%. Current business situation. Investors and businessmen ought to study the causes of this great boom. 3 causes, which seem to me most fundamental and most influential, were 1. Vast increase in public debt, 2. A vast increase in private debt, and 3. Accumulated shortages of goods. From July 1940 until June 1946, the federal government had a budgetary deficit of $211 billion. This deficit was met in part by the sale of government bonds to the banks and by an increase in the supply of currency. The results of this flood of money can hardly be overemphasized. It is significant to notice that this flood has stopped. Since June 1946, the federal government has actually taken in over $20 billion more in cash than it has disbursed. March 7, 1957, The Golden Century, an address by John M. Templeton at Palm Beach. You and I should be deeply thankful that we live in this century. when the knowledge accumulated by men through the ages is beginning to bear fruit in material progress, beyond the imagination of previous generations. In terms of material products, mankind will consume more in this century than in all previous centuries added together. You and I should be deeply thankful for the good fortune of having been born in the United States. In terms of material goods, this one nation alone will produce more in this one century than the total output of all nations throughout the history of the world up until the beginning of the 18th century. For a few minutes, let's turn back our memories to the dawn of this century in the year 1900. The total gross national product of the United States was then $20 billion. The people living then could hardly imagine that the automobile industry, whose annual sales were less than $10 million, would grow more than 1,000-fold. Now the sales volume of this industry alone is almost as large as the dollar sales volume of all industries in the nation in 1900. When this century began, the electric power industry and the telephone industry were in their infancy. But today, these industries alone also total as much as the commerce of the whole nation at that time. The aviation industry did not really begin until 10 years after the start of this century. But now the aviation industry alone produces goods worth over $9 billion a year. In this century, the oil industry has increased 100-fold and is still growing. At the beginning of the century, chain stores were almost unknown, but now our people buy every year through chain stores much more than the total sales of the nation in 1900. The radio industry and the television industry were not even dreamed of then. But now these industries produce $5 billion worth of goods per year. Perhaps these examples are enough to prove that we truly do live in the golden century of the earth. I hardly need mention the other great industries born in this century, such as motion pictures, organic chemicals, refrigeration, rayon, nylon, air conditioning, plywood, aluminum, plastics, and others. You who live in Florida, or often visit Florida, can see all around you the signs of this golden century. The population of Dade County alone is now greater than the population of Florida at the beginning of the century. Beachfront property valued as low as $1 a foot in 1900 can now be sold for as much as $5,000 a foot. The first part of this century has been a golden era, not only for consumers but also for investors. Fortunes could have been made and were made simply by buying land almost anywhere in South Florida at the beginning of this century. Those who were wise enough to invest $100,000 in General Electric in 1910 now have an asset worth $4 million. $100,000 invested in DuPont at the same time increased 160-fold and is now worth $16 million. $100,000 in International Business Machines as recently as 1922 is now worth $29 million. $100,000 in Lincoln National Life shares in 1934 increased 60-fold and is now worth $6 million. $1/10 of a million invested in American Airlines as recently as 19 years ago is now worth $2 million. The dividend paid annually now on a share of Douglas Aircraft is twice the price of the stock just 25 years ago. Those of you who studied economics are probably more interested in indexes that show the average growth of all industry than in these colorful examples. Therefore, on the attached chart, not shown, a line is plotted that shows the growth of gross national product year by year for 56 years. Gross national product means the output of all goods and services in the nation. As I have mentioned, gross national product at the beginning of the century was only $20 billion, whereas now it is 20 times that great. We as investment counselors and you as investors may be even more interested in the second line, which is the index of all industrial common stocks actively traded on the New York Stock Exchange. This shows that $1 million invested in a general cross-section of all industrial stocks at the beginning of the century would now be worth $12 million. Lastly, I have drawn a line that shows the accumulation which would have occurred if all dividends had been reinvested. Startling as it may seem, by reinvesting dividends, $1 million invested by a tax-exempt institution in a random selection of industrial stocks would have grown in 56 years to $250 million. It is certainly no exaggeration to say that this century has already proven to be a golden age for investors to an extent almost unbelievable at the beginning of the century. People who come to talk with investment counselors are usually anxious to hear more about the possibilities of the future than about the facts of the past. The only certainty about the future is the fact that it will be different from the past. Nevertheless, it is entertaining to project forward for the remaining 43 years of this century the trends that have existed thus far. On this same chart, 3 straight lines are drawn projecting the past trends onto 1999. If past trends did continue, then by 1999, gross national product of the United States would have grown from $412 billion now to $3 trillion a year. The index of industrial stock prices would have tripled, and a fund in which all dividends were reinvested would have increased 22-fold. These figures would be greater except for the fact that today, at the starting point, industrial stock prices are already considerably above the trend line. Now let us investigate briefly the question of whether future growth trends are likely to be more rapid or less rapid than heretofore. Those who study population trends tell us that the rate of growth in the future is more likely to be above rather than below the past rate, which averaged 1.4% annually. More important than population is the growth of the nation's industrial plant and equipment. In the first 25 years for which figures are available, this nation invested an average of $6 billion a year in new industrial plants and equipment. In the most recent 5 years, such expenditures have averaged $29 billion annually and reached a record $35 billion last year. This indicates that the rate of increase in the productive capacity of the nation has been even greater recently than it was in the first half of the century. Another factor that contributes to the increase in the figures for gross national product is inflation. Because the gross national product is stated in terms of dollars whose purchasing power has decreased at an average rate of 2.8% annually. Because of the continually rising wage rates and the power of the labor unions, it is likely that inflation will continue a very long time, with only temporary interruptions. Most important of all factors that have made this a golden century in the economic sense is the increase in output per man-hour resulting from new inventions and new production methods. This progress is based on scientific research and industrial research. Therefore, it is important to study the amount of money that a nation spends on research. These figures are most encouraging because they show that research expenses in the United States have increased from $250 million annually 20 years ago to $4 billion annually at present. Altogether, without going into more detail, I can say that the forces indicating an even greater rate of growth in the future are at least as strong as those forces indicating the opposite. Those investors who want to benefit from the future progress of the nation must give the utmost care to the proper selection of their investments. During the first half-century, many investors failed to share in the growth of the nation because they invested in the wrong kinds of investments or in the wrong industries. At the beginning of the century, among the largest investment fields were mortgages on real estate and bonds and shares of railroads. But neither of these gave the owner any real participation in the great growth of the nation resulting largely from new industries. In the remainder of the century, because scientific progress is increasingly rapid, it is likely to be even more important to select growth industries and growth companies. Such selection is by no means an easy task. The outlook is constantly changing. However, our staff of security analysts does have a list of industries regarded as having the best prospects at present for maximum future growth. Listed in alphabetical order, this list includes air conditioning, airlines, atomic power, electronics, new metals, plastics, prefabricated houses, and rockets. These are self-explanatory, except that you might like to know what we mean by new metals. In this category, we include aluminum, nickel, uranium, titanium, molybdenum, tungsten, cobalt, chromium, and magnesium, as well as zirconium, lithium, beryllium, tantalum, thorium, and others. Concerning the airline industry, the rate of growth is shown by the fact that for every passenger mile of air travel in 1932, there will be 200 miles of travel in 1957. Yet today the market values at only $600 million all common stocks of all 12 trunk airlines, which is just 1/18 of the market value of General Motors alone. Now, in conclusion, I would like to emphasize two important warnings for investors. The first of these is the fact that the progress of the nation could be stopped by atomic war, by socialism, or by other great unpredictable forces. The second warning is that the free economy necessary for growth carries with it a strong probability that there will continue to be occasional business depressions and occasional drastic cycles in stock prices caused by great waves of optimism and pessimism. It will be possible in the future, as it has been in the past, to have a fortune wiped out by getting overloaded in common stocks at the wrong time. There will be great investment opportunities in the common stocks of the best-managed companies in new industries. But in years when stock prices are high, wise investors will keep large reserves of high-grade bonds in order that they may have the means with which to buy real growth stocks the next time a major bear market puts common stocks again on the bargain counter. A carefully prepared plan for each investor is the cornerstone of investment success. Sectors and themes. From time to time, Templeton used his letters to clients to address specific ideas and themes that had been identified in his firm's research. As an example, we reproduce here a piece he wrote about the outlook for oil stocks, a theme he returned to many years later, when his predictions had been fully borne out. 1945. Extra value in oil company shares. Oil is a cheap and convenient source of heat and energy. Eventually it will become scarce and the price probably will rise. Statistics on the demand for crude oil indicate a strong upward long-term trend. Demand in 1937 was 22% greater than in 1929. The pre-war peak in 1941 was 18% above 1937. Last year, demand was 20% above the pre-war peak. Estimates by economists in the industry indicate that in the fifth post-war year, demand may be 13% above the best wartime rate recorded so far. Domestic consumption of gasoline has shown an increase in every year except 1932 and 1942. The total amount of oil discovered in the United States since 1859 has been 50,230,000,000 barrels, according to the American Petroleum Institute. Production up until the end of last year amounted to 29,777,000,000 barrels. In other words, the remaining proven reserves in the United States are 20,453,000,000 barrels. This is now being exhausted at the rate of 1,743,000,000 barrels a year. The proven reserves outside the United States, which are estimated at 31,400,000,000 barrels, are being used up at a moderately slower rate. The underground storage of 20,453,000,000 barrels in the United States is not all immediately available. It can be recovered only over a period of many decades. If no further oil were discovered, the scarcity would probably become serious within 3 or 4 years. Even at the present production rate of 1,743,000,000 barrels annually, petroleum engineers estimate that a large proportion of the producing areas are forced to operate at a higher rate than should be permitted if the maximum oil is to be recovered from the structures in the long run. Additions to the underground reserves of the United States through discovery of new pools have been declining sharply in recent years. Thus, in 1944, only 511 million barrels were added to reserves, compared with some 929 million barrels in 1937. It is significant that new discoveries have added only about 385 million barrels annually to reserves in the 6 years ended December 31, 1944. These figures do not include the increased reserves through revisions of estimates and extensions of the older fields, of course. Also significant is the fact that the number of dry holes drilled has been increasing. About 3,600 wildcat wells were drilled last year, of which 11.5% struck oil, 3.1% gas, and the remaining 85.4% were dry holes. Some of the most promising areas have already been covered by seismograph mapping parties 4 or 5 times. While the cost of locating new reserves has risen sharply, the price of crude oil, except in special areas, is no higher than it was 7 years ago in 1938. The industry has agitated for a general price increase, but such efforts have been repeatedly blocked by the CPA. In the last 30 years, the price of crude oil in the United States has been as low as 33 cents a barrel for a few weeks in 1931, and as high as $3.50 a barrel for several months in 1920. Crude oil prices are not revealed in foreign areas, but it is significant that retail prices of gasoline and fuel oil in almost all countries abroad before the war were substantially above United States prices. A price increase of as much as 50 cents or $1 a barrel at some time in the future would not appear unreasonable. Eventually, when oil becomes really scarce, a price increase up to $4 or $5 a barrel would probably result in the use of substitute fuels or in the extraction of oil from other materials. The known deposits of oil shales and tar sands are sufficient to postpone the exhaustion of oil resources for several generations, but extraction from those sources is quite expensive. Also, coal can be converted into gasoline, and much progress has been made toward reducing the cost of the process, especially in Germany. Until the price of crude oil is much higher than now, the conversion of coal or other organic materials into oil cannot be a source of competition, because the raw materials for such a process of chemical metamorphosis cost more than tile current price of crude oil. At present, because of the labor in mining, the cost of a ton of coal exceeds the cost of a ton of crude petroleum. An increase of as much as 50 cents or $1 a barrel in the price of crude oil would attract only minor use of substitute fuels and probably no oil production from substitute sources. Furthermore, a price increase of such proportions should encounter little consumer resistance. An increase of 50 cents a barrel in the price of crude oil would cause an increase of only 1 cent a gallon in the retail price of tile oil products. Whereas a price increase of 50 cents a barrel would have little effect on the demand for oil, it would have a large effect on the asset value and earning power of the companies which own the major proven reserves. In the attached tabulation, not shown, the added value caused by a price increase of 50 cents a barrel is computed for 20 oil companies. The approximate increase in earnings per share is also computed by use of 1944 production figures. The increase in asset value shown in column 3 is based on the assumption that producing properties would command a sale price of 30 cents a barrel more if the posted price of crude oil increased permanently by 50 cents a barrel. The increase in earnings per share shown in column 6 is based on the assumption that 30 cents a barrel extra would be carried through to net earnings after taxes if the posted price were 50 cents higher. The figures for added asset value are derived from the estimates of proven reserves shown in column 1. Such estimates are subject to a wide margin of error. The number of gallons to be produced from a particular field depends on production methods, prices, and other variables. The careful estimates of company geologists are made available to stockholders in only rare cases. Furthermore, the figures in column 1 contain no allowance for natural gas reserves, which are so important for Phillips and others. The huge reserves held by Gulf, Standard of California, and Texas in the Near East are not included. Despite these limitations, it seems indisputable that a stockholder can form a more accurate judgment of the value of his shares if he has some estimates rather than none. No one can tell when an increase in the price of oil may occur. From time to time in the future, there may even be temporary downward adjustments, as there were in the past, when exploration methods were improved by new inventions and when huge new flush fields were found. Peroration has been made very effective in recent years, however, and this protects to an important extent against sudden price cutting. In the long run, the powerful influences of increasing scarcity and higher discovery costs point unmistakably toward large and permanent price increases. The current market prices of oil company shares seem to take account of the potential added value only to a very minor extent. The present prices can readily be justified solely on the basis of current earnings, past average annual earnings, and stated asset values. Assets of almost all oil companies are now worth more than the amounts shown on the books. Earnings are greatly understated by Amerada and several others. As can be seen by the last column of the table, potential added values are very large in relation to current market prices. This is especially marked in the case of Amerada, Gulf, Lion, Ohio, Pure, and Skelly. This is